Good morning, everyone, and welcome to our two-day meeting of the Retirement System Investment Commission. First thing I want to tell everyone, if you haven't already been told, is Mr. Harper is the only one attired formally, but we are going to be business casual today anymore because of the heat. Now, there's lots of things we can do, but we can't control the temperature, but it's comfortable near the Herschel, you're welcome to take off your coat unless you want to make us all look bad. Is that what you're saying?
Well, I'll be happy to take off my coat.
All right, so let's call the meeting to order, and first is our consent agenda. So we'll need a motion to adopt the proposed agenda.
So moved.
Second? Any discussion? If not, all in favor, signify by saying aye.
Aye.
Aye. Any opposed? None. Motion is carried.
Very good. Approval of the minutes.
Next item is the approval of the April minutes. May I have a motion to approve? Second?
Second.
Any discussion? If not, all in favor? Aye. Opposed? None. Motion's carried. Minutes are approved.
Okay, next be your report, Mr. Chairman.
Next item will be the chairman's report, and first item is I would like to have a moment of silence for the victims of the incident last night at the Emmanuel AME Church in Charleston, and particularly for Senator Pinckney, who was a member of the retirees, and our condolences, of course, to their family. So please, let's bow our heads for a moment. Thank you. Secondly, we have compiled the results of the Commission Evaluation Discussion Guide with the assistance of our HR Director, John Farmer. The summary was posted to the watch box for the Commissioner's review and will be discussed later on today. Third item will be the Executive Director's report. That's Mr. Hitchcock.
Thank you, Mr. Chairman. Mr. Chairman, just to echo your sentiments earlier, and I appreciate your leading us in a moment of silence. The tragedy in Charleston is heart-wrenching, and I mean, for me, is somewhat personal given my service as an employee of the General Assembly, especially the Senate, and the years working with Senator Pinckney. I can tell you that he was probably the nicest person that I've ever met, especially in the General Assembly and in the Senate. He was a true statesman. Fortunately, I guess the only good thing that can come is that he died doing what he was called to do, and I think that we should all just remember his service, and it's just, as I say, it's just a personal moment for me. So I appreciate you leading us in that moment of silence. Changing over just a little bit, today is also a day for me that of kind of a special day, because and not necessarily in a good way, because I don't think I've informed the commission of this yet, but we are losing one of our most faithful employees. I think everybody knows Miss Lori Smith very well. I often joke that Lori has the hardest job of the staff on the commission, because her job is to manage me. So that usually gets me a little bit of a chuckle, not from her though. But I just wanted to say that Lori is leaving us quite selfishly, in my opinion, to go with her husband to Washington, D.C., because he's going to be pursuing a master's degree in business at Georgetown University. So I can tell you that I've worked with a lot of people in state government. I have never worked with anyone who I thought was so dedicated and so professional, and I think she's been a true kind of the heart and soul of this organization for a long period of time, and I don't know what I'm going to do without her, and I don't know what we're going to do without her at the commission, but we'll try to fill some enormously big shoes. So if we just take a moment and recognize Lori for all of the years of service to the commission and also to the state of South Carolina. Moving on, also wanted to give the commission an update on the state budget. It is now July 18th, or June 18th. It might be July 18th. It might be July 18th before we get a state budget. But it's June 18th, and the new fiscal year is fast approaching. At this point, unfortunately, the General Assembly does not have a budget. There will be a continuing resolution at least in place. I know that the General Assembly both houses are working diligently to try to get a state budget passed. The implications for the commission for us is that if there is a continuing resolution for whatever time that continuing resolution would be in effect, from a budget authorization standpoint, we'd be operating under last year's budget authorization, so basically on a prorated period for whatever time that continuing resolution is in effect. So we are making preparations for that, just in case that it turns out to be an extended event. I don't anticipate that, but in my memory, the General Assembly's only passed or operated under one continuing resolution, and I believe that was for about 2 days. So hopefully that will be resolved quickly. Can tell you that the General Appropriations Bill itself is now in conference, and just to give you kind of broad high-level highlights of how that affects us and our current and the authorization for the next fiscal year. The House has authorized us a total authorization of $15.3 million, and has authorized an additional 6 FTEs. The Senate has authorized us 9 FTEs and $17.8 million in total authorization. In conference committee, the two sides will work in between those two numbers. I think that that demonstrates some significant progress, as in this area for the commission, and I'm happy for that. We're certainly happy with any additional authorization that we would get as a result of that. So I will, once we have solid budget numbers and we know the total number of FTEs, I'll be working with my senior staff to apportion those FTEs across the organization, and I will be coming back to you with a new organizational chart, which will also incorporate the organizational changes that we've made in the interim since the last meeting that were detailed in the memo that I sent to you. So if there's any questions about that, I'd certainly be more than happy to answer those. Okay. Moving on, the one item that came out of the HRC committee that the commission would need to act on in this meeting, because it has to be done before the fiscal year. All of you, I believe, have passed out Appendix B, which is on page 14 of the commission's compensation policy. And this sets out the performance award scale and the maximum pick opportunity for the fiscal year for the investment staff. Under the compensation policy as it currently exists, the commission has to, in essence, reaffirm this every fiscal year. This is something that we would have normally have done much earlier in the fiscal year, but we were thinking that we would have the compensation study would have been done, and we would potentially have a new compensation proposal for the commission. Due to some procurement issues, as we all know, that has not been completed. We don't think that there will be a deliverable on that as far as a recommendation to the commission for a new compensation policy until sometime in September. Therefore, the HRC is asking the commission to reauthorize or reaffirm these parameters as they existed for 2013-2014 to apply to this fiscal year. So in essence, this is what we would use to make a recommendation to HRC and then to the commission in regards to performance incentive compensation for the investment staff for the current fiscal year that we would look to bring to you sometime in the fall. And we would just need just a motion to affirm that. Okay, thank you. And it would just be that the commission confirms that the existing maximum pick opportunity and performance award scale set forth in Appendix B to the compensation policy are to be applied to fiscal year 2014-15.
I just have one, well, I guess we need to get the motion on the floor before we're supposed to discuss it, right?
We have a motion.
Second.
Any discussion?
Yeah, what are, I mean, I guess question for HRC, is how are we tracking? We've had a lot of position title changes, right, which obviously impact this. You know, how's that tracked and linked, as well as new hires, right? I know we had a kind of a phase-in
Sure.
of eligibility. I mean, how do both position title changes impact this and, you know, as well as new hires?
That's a good question. Obviously, the maximum percentages would apply to, you know, and all of the title changes have tracked the either analyst, officer, or director. So the percentages would apply. And the way that we would look at it, for instance, if we've had someone who was moved from officer to director, I believe the way that we would look at that is we would look at their total compensation for the year and then apply the appropriate percentage to that. Last year, the commission did reaffirm that for folks who begin, or who are only here for a partial year, that that they would get a prorated percentage of their incentive compensation. So, yes, but we are tracking that, the position changes and the changes in compensation as well.
But are we linking because this is percent of base, right? So if you
Right.
have a blended base, right, if you don't prorate the year,
We can,
right, like even if you took total comp for the year, like you look at sort of payroll, but then you apply 100 versus,
Right, and I
say it
think-
was, you know, lower at 80 and then half at 100, and then you've got to prorate it on that bonus cap. Does that make sense?
yeah, we'll work that into the calculation when we present it to you. The blended, I get your point, and we'll
Yeah.
work that into the calculation. when
Right,
we
like
bring
you
it to
can't just take W-2 comp and
Sure,
then
right,
apply that 5%.
Right, we
So
would
it
we would
wouldn't be
prorate the,
Right.
and I think that there might only be one or two instances where people have gone from one
Grid to
one grid to the other. So we've had, I know, at least one promotion from officer to senior officer, which doesn't change. One promotion from director to managing director, which again doesn't change the overall percentages. I think we've had maybe one or two from analyst to officer, but we'll work that into the recommendation when we bring it to you.
I would say the idea would still be a pro rata
Yeah.
Mhm.
for, if they were an 80% and then they went to 100%, that you would still get a pro rata for when
Right.
they
Right.
changed.
Do we have a list of those eligible?
We can get you that. It's all the investment, what we consider to be the investment staff, but we'll let you know. We'll get you a list of who those folks are.
Do we have a concern, because we are ramping up, hiring more folks? So many new folks coming in, and in the first year, grabbing a bonus. And, you know, I think you'd be pretty hard pressed to find that outside of here. I mean, we had a bunch of people around, I was trying to find out about how bonuses work and all that. And it's something I think we ought to think about and look at, because, you know, it's supposed to be a long-term incentive. And of course, we go back to, I would say every year, and it's crickets when I say it, our rate of return, and especially our strategic benchmark, is the very last of our peers. I mean, we're the last, not next to last, we're the last. So all we have to do is beat that. So it's a perverse incentive. And I think if we keep this incentive the way it is, we will continue to be right where we are.
And,
Well,
if-
I was going to say your point's well taken, and I think it's worthy of discussion. And I would suggest that perhaps that is something that we need to talk about.
Yeah. Well, Mr. Chairman, if I may, I think this is the last year that you will see this, at least under our recommendation, probably the last year that you'll see this the way that it is. And, you know, we're currently working with the compensation consultant to really construct a complete compensation system, where we really look at each individual position from a total, what we believe that position is worth from a total compensation perspective. And also trying to determine and looking at other, and, you know, really kind of a broad range of plans and how other, both folks in the public and private sector would award incentive compensation. How much of that compensation should we require to be placed at risk? And also, how do we best find an alignment of interest between plan performance, not only to just beating the benchmark, but also potentially how do we also work in the statutory assumed rate of return, those types of things into a incentive compensation piece, or quite frankly, or if a continuation of incentive compensation is where we go. So really, all options at this point are on the table. Would certainly welcome any input from any of the commissioners on their thoughts on where that they think that would be. Any recommendations that we have, we'll first vet with HRC, so that there'll be an opportunity for a full discussion there with HRC. And then, of course, any changes that we make, there'll be plenty of opportunity for full discussion with the members of the commission, but we'd certainly like any input that any of the commissioners would have as we're going through that process. So, there's some good and there's some bad in incentive compensation. We're trying to figure out how to maximize the good. So, but your points are well taken.
Yeah, I mean, I would just point out that, as we kind of go through the process, in the past, we purposely try to keep it simple. But I think that the question about the relevant policy benchmarking, that ultimately flows from the asset allocation that we adopt. I mean, that's really something that, we're supposed to get that with input from staff and consultant, but ultimately that's our decision to make, right? Because the incentive comp really then runs a relative off of that benchmark, but that decision's ultimately owned by us, that's not a staff level
No, and I agree
decision,
100%.
right?
And with this being the last of this policy, I didn't want to say too much about it, but as I was going through, this is just part of the information we've had about a week to go through. Is there any doubt what we do? I mean, could I not make a motion right now that all these motions be called and we can leave here in 10 minutes? Because everything is going to pass and everything is going to go exactly like it's designed in here. So I just think it's something we ought to say, and we vote on the choices given to us, because who here has got the time as a commissioner to go off and do what it takes professionals, a whole big team of professionals to do. So let's not kid ourselves. This is ours, but it's also staff. And I look at these every month, every quarter, 10 years predating this group, dead last. And I just don't see how our strategic benchmark serves the retirees. I mean, I just look at it dead last every time. So I said enough, I think, and
Mr. Chairman, if I could, Mr. Treasurer, I think that's, I understand your point and your perspective. And the one thing that we are, from a staff level, hopefully to give you some comfort that we're moving towards is a much more collaborative effort when it comes not only to implementation through manager selection and through any tactical moves that the staff recommends to the commission that we make, but also through the strategy when it comes to strategic asset allocation, both on a short-term and a long-term basis. So we really are, from a staff focus, all in on both the strategy part and the implementation piece, and we're trying to make sure that we're focusing a good bit more attention on that strategy piece, on that asset allocation piece, so that we can make good recommendations and we can hopefully help the commission construct a portfolio that gets us over the benchmark, and really from a staff level taking ownership of that piece as well as the implementation piece, so that we have, in essence, skin in the game on both sides of that ledger. So just wanted to make that point, and hopefully that will. But again, we had hoped that we would have something, a much better option for you. But at this point, as far as incentive comp goes, but unfortunately, procurement is what it is, and we are where we are. So, but I think we'll have a good recommendation for you on a new way to do things in September.
Well, I think that's a good first step forward. So hopefully, after all these discussions, we'll come up with a better plan that'll address some of these concerns, and rightfully so.
Yeah, I think I would just like to say that I think it's good that we do have a compensation consultant that's going to look at this. It's unfortunate that this last year we're under the plan that we have right now happens to be a year that we fall so far behind our assumed rate of return. I think that is going to create some public perceptions and criticisms of the commission, but as you say, it is what it is. I think the important thing for us to look at is the need for that compensation consultant, the need for us to evaluate our PIC plan compared to our peers across the country, make sure that we're evaluating that against the benchmark in an appropriate manner. I just wish that we were further along in that process.
Yeah, I mean, but I will say, right, I mean, we worked with compensation consultant before, and this is linked to a 5-year number. It's not linked to a 1-year number. So part of, I mean, I think this gets back to, are you trying to set out long-term objectives, or you're acting to a fiscal year every time, right? I mean, market returns aren't this smooth thing, and I get the headline risk of it, but I mean, this, you know, the comp is linked to the 5-year number predominantly, or phased in by the length of time that the employee's here, right? So it's not linked to what happened in the last 12 months, right? And nor should it be, right? But I think that brings up the other part. I mean, ultimately, in compensation, I would like to find a way to defer it and, you know, withhold it back, and, I mean, it's more tax efficient, I mean, any number of reasons, but that's a, you know, but I think when these headline numbers come up, when people get paid in the fall, right, I mean, I think it's important that we remember it's based on a 5-year, not a 1-year outcome. Yeah.
Good point.
Yeah. And, Mr. Chairman, and I think that, you know, it's important for us to, you know, and I don't know if we've necessarily done a fantastic job of this, but when we look at the investment staff and we look at compensation, you know, we really making the determination that for a particular staff level position, that this is what that staff level position is worth. And then we're requiring that staff person to put a significant amount of that compensation at risk. But I think that there's, you know, we're looking at this from a completely ground up approach. And as I said, all options are on the table, and all options are being explored as to how to make this, to have a significant alignment of interest with the overall performance of the plan. And also, you know, from my standpoint, be able to recruit and retain good talent as well. So, thank you, Mr. Chairman.
Well, and just lastly, I think it's important that when we get this input from the compensation consultants, I think that will give us a very good idea of where we are, what we need to do, and then we can refine it from there. So I think, as the executive director has said, we will move on, and of course, we welcome any and all suggestions. Anything else? If not, we need a motion to approve the compensation plan.
I think you just
We already
need to-
had the motion.
Yeah, I think you just
We
need to-
talked about it.
Oh, then, did we get a second?
You just vote.
Okay, all in favor?
Aye.
Any opposed? One opposed. Motion's carried. All right, let's see, we'll now move on to the audit committee report. Mr. Gillespie.
Robert. 4-1.
Okay. So audit committee met on May 15th to receive status updates on internal audit plan, ERM, and compliance activities, and the legislative audit request that the RSIC has received. We had discussions relative to the organizational risk assessment for the upcoming year, which will, from that, then we'll derive the audit plan for 2015-16. We received presentations from the operational due diligence team, as well. The actions that the audit committee made, we went back to this, this came up a while back, but, statutorily, we have the 70% equity limit, on investments. Obviously, that gets to be kind of a layered question. Is it at market? Is it at cost? What constitutes equity? How do you adjust for leverage, right? It's not as necessarily as straightforward, but the audit committee is recommending, as it stands today, I think the commission had voted that it was at cost, but that we should move to an at-market test for purposes of that statutory provision. So I believe there's a motion in the materials related to that. Item 4. And implicit in that is authorization for staff to develop the appropriate testing methodologies of how we want to go about conducting that test.
Chairman, will you read the motion?
Yes, go ahead.
The motion be the commission adopts the audit committee's recommendation that testing of the 70% equity limit imposed by state law be done on a market value basis, and 2, staff is authorized to develop and implement appropriate testing methods Further, staff is authorized to amend the SIOP and other documents as appropriate to reflect the foregoing decisions.
Motion to approve?
So moved.
Second?
Second.
Any discussion?
What does the term testing mean in this context?
Yes, it's when they actually look at the valuation and they go and they test to see where the limit is. So right now, it was based on cost, so the limit says 70% has to be, and we would do that computation on the cost value, on the cost basis. What we're recommending is that 70% be done on whatever the market value is at that point in time.
And so it would be a calculation
Yes,
of a percentage of our portfolio
right,
in equity.
that's correct.
Thank you.
And how often would that be done?
Annual.
Annually, I believe.
Annually?
Well,
Yeah.
it's based upon rebalancing, so Herschel might be the better one to kind of talk about it, but, I think it can be triggered at any point in time, but there are tolerances to allow, I mean, we're nowhere near that threshold, so, but it's really geared more for the ability for them to be able to rebalance. So I'll defer to Herschel on, kind of how you guys figure that out on I know you look at that more frequently than annually.
Yeah, we do. From the aspect, we're looking at it pretty much weekly from an asset allocation perspective and understanding where the actual exposures are. And then we've introduced, for the funds and recommendations, we'll actually have a quarterly meeting where we do it on a more formal basis to take a look at it quarterly as well. And then, so the information comes to us from the performance and reporting team, and they're pulling information from Bank of New York as well. And so that would be based on more of the market values that we have at that point in time as opposed to cost as well, so.
But you'd still rebalance this annually?
No, the rebalance would be, that's a decision that could be made
Anytime?
throughout the year,
Oh, all right.
but more formally reviewed on.
Yeah, the easiest way to actually run the test is gonna be to use year-end calendar values, right? Because we have so much in private equity, right? I mean, that's when you're gonna have a true, I call it versus, roll forward NAVs, you'll have true NAVs. So from audit committee's perspective, I suspect just taking the year-end value is gonna be the easiest way to run the test. But I don't think we're anywhere close, so I don't think it's a big deal, but it is in the statute, so we need to go through the process.
And you had made a comment earlier about what we define as equity.
What we define as equity, yeah, so, again, the statute just says 70%, but, do you account for leverage, do you account for derivatives, do you account for, it's kind of open, right? I mean, as Herschel will tell you, you adjust for leverage, your equity exposure could be quite different than what you have in a traditional sense of invested in equities, right?
So,
So the way we actually look at it from an exposure basis would be if it's an equity-based derivative, we count that towards the equity
Okay.
exposure.
But you have to
If it's-
account for the leverage of that instrument. So like you could put $100 million in an option, but have $1 billion of exposure.
so we're taking a conservative approach to what we.
Yes. Yes.
Okay. So we're not underestimating our exposure?
No.
That-
Right.
Okay.
We're south of 70.
All right. That's-
Well
okay. No surprises. All right. Anything else on audit?
Well, that would be, we just need to have the motion, or put the motion to a vote.
All right, the motion is, do you want to read the motion? or do
We did, yes.
Go ahead.
Yeah, it's made and seconded, we just need that, you just need to call for the vote.
Okay, then we need a vote to approve that motion. So, second?
Well, it's already second.
Yeah, it's already-
In favor.
Oh, okay, all in favor?
Aye.
Aye, opposed? None? Motion's carried. All right, nothing further there. Let's go to the CIO's report, Mr.
Thank you, Mr. Chairman. And as we mentioned a little bit earlier, this is a two-day meeting. Today's meeting is really focused much more on the business items, and then a little bit later today, we do have some investment recommendations, and then tomorrow is really much more about the investment strategy and asset allocation. Today, I'll make some brief comments. I do want to, update the commission that there was communication about Mr. David Phillips, who has left the organization and joined another organization. So that communication did go out to the commission, but I did want to show a quick update to the org chart as it reflects on the investment team and some of the changes that we've made there. And so, as I'm looking at this to my left, the asset allocation and risk management, that is the team that David Phillips led. We've asked Wei Ning to lead that team. And under there, you'll see the key focuses that she'll have under her responsibility, and then a little bit lower, the team that she has. And so we will be recruiting a senior investment officer as a replacement for Mr. Phillips, who will report to Ms. Ning. And their core responsibilities remain risk management, the portfolio construction and compliance piece of it. Think about asset allocation, the macro research piece. Also, we've asked Mr. Berg to lead the entire manager research arm. So he will be doing that. So private markets will be under Jeff, and that's a little bit of a change from what you've previously seen. Within private markets, David Haas will lead the private equity efforts. Adam Jordan will lead private debt, and Eric Ravelli continues to lead the real estate efforts. Within the more liquid or public markets, the global core strategies, Brian Moore will lead those efforts. And again, that's going to be more your traditional equity, fixed income, credit, and hedge funds. And then further to the right, Mr. Addy, Mike Addy, will continue to run the internal fixed income, short duration and cash strategies that we have. And then under there, you see the listing of the team supporting public markets. And if I think about from more of a fun.
Did you mind going back to that
Sorry.
chart just for a second? I mean, I guess my only question, I'm just kind of struck by the number of people we have to the public market side versus the private, given the size of the private, right?
Yep, so that's a, yes, sir, that's a good question to have. And assuming we get new FTEs, we would actually add to that vertical. But right now, the way the manager coverage responsibilities are divided up is there are people in the public markets team who actually have private equity experience who are actually supporting those efforts as well. So the entire burden for private markets is not just on those 5 people. So it is spread out. The portfolio strategy and investment management, so that's really the internal investment committee, and those are the key functions of that committee. And what we've done is we've broken out to actually focus one meeting on asset allocation, and then the second meeting will be focused more on the manager research or the investment implementation. And so this is just a highlight of those key responsibilities, and we will be working on what kind of key things. And so Wei's team is going to continue to lead the asset allocation, risk management, and bring that idea, thought process, and control and compliance into that meeting. And so we'll have that discussion, and that'll also include the rebalancing and tactical tilts decisions and so forth. And then Mr. Berg will be key for leading the investment management implementation, so looking at the investment managers. And as a subcomponent of that would be strategic partnerships and co-investments as well. And again, that's the manager selection component to it as well. So if you think about the kind of 2 levers of asset allocation and manager selection, that's how we've structured this as well. Both coming into the internal investment committee for final decisions that would then come back up to the investment commission if the commission has not delegated other decisions to the CIO or staff. So that's a breakdown from a functional perspective. Thinking about what are we going to be doing this next fiscal year, you're very familiar with these key things here as you've approved them at the April meeting. But as a bullet points, let me walk you through from the infrastructure build-out component for reporting and the investment management component. That's really where Mr. Chernick's leading those efforts. That's where it links back into the Conifer system as well. The ERM and compliance oversight, so that's where Mr. Nelson will be leading those. Then the next few things are really focused much more for the investment team for key initiatives. And again, the strengthening of the research and risk management, portfolio construction capabilities, that's really going to be led by Ms. Ning's efforts there. The decision-making process and discipline around that and the multifunction kind of incorporation of quantitative and qualitative will be a group effort of both the risk portfolio construction as well as the manager research team. Continuing to develop and foster strategic relationships. This is where I'll spend a lot of my time as well. And also ensuring that we get the knowledge transfer, and we're looking at unique deal flow. The reporting component for strategic partnerships and co-investments, we've already started that. We look to continue to improve that. and obviously welcome any feedback of things that the commissioners would like to see. We'd like to be responsive to that. So we'll have that discussion a little bit later today with respect to actually walking through that report. Co-investment platform, again, we do have a dedicated team. It's a subcomponent of the manager research team of people that do have experience either working on direct investments or mergers and acquisitions in their previous lives. And so we do have a team that will focus on those as well. The strategic discussion and review of asset allocation, that was one of the things that the commissioners had asked for that we focus a little bit more on. There was also a Funston recommendation. And again, the second day, tomorrow, is dedicated to that as well.
Just a question on one of the items there, I forget what it was about the strategic partnerships and the co-investment. How much overlap is there between the two?
I would say probably, we'll take a look at that, 85 to 90% of the co-investments or direct investments will be in partnerships. I'm not sure if I'm answering your question.
Well, I guess the question is, how do we, they seem to be two separate initiatives, but you're telling me that a substantial amount overlaps. So I guess the question is, should there be a greater differentiation, or should it be closer to one initiative?
They are highly related because most of the co-investments that we source will actually come from strategic partnerships because of having a vehicle to actually close the deal in. Also, as you'll recall, we have made allocations to private equity managers and real estate managers that do have sidecars to them as well. So I wanted to make sure we're capturing that. And so the strategic partnership and fostering those relationships is one focus to make sure we're having strong alignment, we're getting the knowledge transfer, we're really getting the savings from an economics perspective. So there's the relationship management around the partnership and relationship itself. But then also it's to make sure that we are looking at getting the underwriting correct with respect to the unique deal flow that we get. So that's why they're looked at as two separate things.
Okay.
But they are tied together.
Very related.
Very related. So that will actually conclude my comments with respect to a quick update, and I will ask Mr. Jeff Bird to give the performance update. I think Ms. Bernard will follow on.
Good morning. There's a lot to get to today and tomorrow, so I'm going to do everyone a favor and be as efficient with my comments as I can be. I reorganized some of these slides in order to be more efficient, but as always, if there are any questions at all, please interrupt at any time. Before I get into what is our fiscal Q3 update, I wanted to just make sure that I did let everyone know that through last Friday, the fiscal year to date estimated return is 2.06% versus the policy benchmark, which is exactly half of that, 1.03%, which is going to, that's a different number than we're going to look at today in depth, but I want to make sure that we did provide the most recent estimate we could. So as is our custom, I'll start with looking at the returns of the market indices themselves before we get into our actual performance. Excuse me, I just need to move that a little bit. So here we're looking at the returns of the benchmarks for each asset class. And when you roll these up according to their weight in the policy benchmark, you see at the top there the policy benchmark return for the fiscal year to date through March 31st is only 53 basis points. It is certainly not changed by much since our last meeting. Real estate and private equity continue to be the better performers in this list, while commodities just continue. There's really no other way to refer to this other than this has been a dismal asset class. And when you think about our goal of earning 7.5% on a long-term basis, you apply that to the fiscal year to date, The only asset class benchmarks that are on pace to do that this year are real estate and private equity. So let me put that a little bit differently. Holding a balanced portfolio, it just is not giving us the lift that we need this year. This is one of those years.
And we should, real estate and private equity are both privately valued, illiquid markets. We're taking the general manager's opinion about the values.
Real estate's an appraisal based,
Yeah.
to your point, I believe. So, and that's a benchmark. So to be clear, the benchmark is for private equity is a public benchmark. So it's a public benchmark plus a spread. So that is known. And I'm going to get into a little bit more detail on that topic in just a moment. So this is the performance of our actual asset classes. We're pleased that on a rolled-up basis, we've been able to add 63 basis points beyond that which the markets have given us. In dollars, that's $180 million. So this is not also very different from what we saw at the last meeting, which was updated as of February. You can see that our execution and I'm going to show another chart that will make this even clearer. Our execution in both real estate and the hedge fund spaces has been quite effective, while on the other end of the spectrum, the global fixed income assets have done poorly versus their benchmark. Good news is we're at the tail end of the restructuring of those assets, so we feel quite confident that we've addressed this and feel good about it going forward. One thing I want to make sure that I explain, because I think it is nuanced and it's easy to judge it harshly, our private equity performance trails its benchmark over the 9 months, and it trails it appreciably. However, when you look at the performance of the private equity assets at 5.5% and compare that to if we didn't use private equity and all we used was public equity, we would be looking at 150 basis points. So the decision to invest in private equity on the surface, notwithstanding your point about the way in which it is valued, it's hard to say that the decision to use private equity is a bad decision. It certainly is outperforming what we would do with those assets in order to obtain equity risk otherwise. However, sometimes the benchmark and the way this benchmark works, it just works again. It makes you look like something bad has happened, and I don't think that's the case here.
Jeff?
Yes, sir.
Question, just going back to that last
Oh,
slide.
Sorry.
If I'm reading that chart right, it looks like hedge funds, both year-to-date and fiscal year-to-date, have outperformed pretty well, despite criticism that we've heard about underperformance. So what are we doing right to get those kinds of, to get that kind of performance?
You're going to, that's a very good question. We have some managers, and I don't know that there's any issue naming them by name. Lighthouse has done a very good job for us. Bridgewater, who's going to be here tomorrow and spend a good deal of time sharing their perspectives, they've done an excellent job. D.E. Shaw. We have a good stable of managers in the low beta hedge fund bucket. So it's manager selection. Not to toot the collective horn here, but when you choose good managers, they make you look like you know what you're doing.
Well, I think the significant thing is that if at that 8.54 fiscal year to date, if that were to be, if we could carry that through the next quarter, we would be in excess of that 7.5, and that doesn't look like such bad performance to me.
Well, this is the line. Everything above here, so there's two asset classes that are on pace to outperform 7.5. So if we, again, everything below 5.5 for private equity, you roll that forward 3 more months at the same rate of return, that doesn't get you to 7.5. So that's the line. This is a year when markets just aren't giving you the lift. So these are more alpha strategies. So you think about the traditional way of thinking about the composition of your returns. There's the risk-free rate, and we all know that's very close to zero, plus the return for markets, which is the beta component. As you see here, the betas just aren't going to do it, plus alpha. So betas are taking us to 0.5%. So we're not going to get 7% from alpha reliably every year. So this is just a year when the markets are not doing what you expect over the long-term markets to give you.
Question, we talk about the hedge funds, but what's driving the private equity? Is this smoothing? Is there something particular with our managers? What's driving that?
Looking at private equity on a 9-month basis is just never going to be the way you would want to look at it. So I would encourage you to look at the longer period returns. And as you know, if we go beyond 5 years, you're getting into that real steep J curve when you're really building a program. So we're getting to the point where looking at the longer term numbers, I think, is reasonable. And you see in the out years here, a 5-year number of 14%. That's great. It's time-weighted return. So I would even, if we're going to say that numbers are not good numbers when they're low, we also need to say they're not great numbers when they're high. So a time-weighted return for private equity, I don't think is the best way. I think we have good managers, but I think that what we need to do is to do a more robust look over a longer period of time of the entire program in order to have some thoughts about how we want to do this.
Jeff, if I may, we'll have internal rates of return in
Okay,
our section
great.
of the report,
Yes.
so we can go into that a little bit. But I would echo your thoughts
Yeah.
that any short-term numbers are going to be very misleading in private
Yeah.
equity, be they good or bad. And we'll see that some that are
Yeah.
quite good that are misleading
Right,
too.
but I mean, the bigger point of the question, and this gets a little bit even ultimately to the co-investment thing, right, is are you trying to run a program where you're really wanting to center around these averages over time, or are you really trying to add value through manager selection, in which case this basis differential could be, 500 basis points over time. I mean,
Yeah.
I get on a 1-year number doesn't make sense, but, there's a material difference in the likelihood of that sort of dispersion on a 5-year number, depending on how you construct the program.
Well, the other thing is, when you look at the fiscal year-to-date number, so it's public benchmarks, lag 3 months, plus 300 basis points.
Right.
So there's just going to be a lot of discordance between looking at that benchmark and looking at our performance.
Right.
And it sometimes it doesn't look great, and you live with it, I think. So that's my perspective on it.
Let me comment too on kind of the structure of the private equity program. There are different ways you can go about it, and some people just want to slavishly have vintage year diversification and a cross strategy, and we're going to have a pacing schedule, commit to it every year. And there are plans that have done that for a very, very long time and have done very well doing that. And our approach is when we started private equity, then the world fell apart. And so as opposed to a traditional pacing model, then what we actually started doing was being much more opportunistic with our private equity allocations. And then we've also backfilled in with some vintage year diversification as well and strategy diversification. So ours is really a combination of trying to be opportunistic, finding that dislocation itself, as well as adding in and trying to layer in the vintage year diversification component to it. And I think that, over the past 12 to 18 months as well, that you've certainly heard a lot of private equity managers talking about they're much better sellers than buyers, just because of where the markets are. And I think that many will tell you on the near-term basis that they believe that where the opportunities are, they're going to have to be much more nichier and find things that are very, very different. And so that kind of leads you back to more of that opportunistic as opposed to pure vintage year diversification. And I think the managers themselves will be doing the same thing. But one of the things that we've been guarding against and looking at is the fact that even our private equity funds, say buyout, is a lot of managers that have been going into the energy sector. Not a surprise. Financial crisis happened, a lot went into financial services. So that's not a surprise, but we also are looking at energy managers and energy allocations, and so we have to balance out how the buyout managers are approaching it versus our specialist managers, and what's the differentiation. Are we going to end up with the same overlap? If we are, we need to make a different decision. And so those are the components we're looking at as when we build out that program. But we still do want to think about, we're not going to have perfect timing because it's not like a liquid market. Once you commit, you commit. And so your ability to be tactical is somewhat limited. But we still want to have the ability to help or try to identify where dislocations have occurred and tilt the portfolio. So we are trying to be somewhat tactical, recognizing you cannot be perfectly tactical within private equity. So it's really built out from a combination of things. And I think this actually gets back to where the strategic partnerships can be very instrumental. And if you talk with an Apollo, that the approach there has been where are the best opportunities in the market to make the most money. And that's where they're going to look to allocate capital, as opposed to saying, hey, we need to have diversification across every sector. And so that's been an approach I think that served them very well too. So hopefully that kind of adds to that conversation. for you.
I'll just add one more lens, and this, I think, perhaps sets up Suzanne quite nicely, is the real question, I think, in terms of does it make sense to be a user of private equity is, does it give you a better return than if you didn't have it, right? So are we better off for having used private equity? And Mr. Treasurer, you point out something I think is an issue, which relates to the today's valuation, right? But as you look back through time, today's valuation is tomorrow's realization when they ultimately sell a company. So when you look at the longer-term performance, the valuation issues kind of fade into the background, and you're seeing what were the actual realizations done at. So, but I think looking at the holistic, how much equity risk do we have, and how much of that is public versus private, is something that lends itself to judging your private equity program in a way. Are we better off than if we didn't have it? So, are there any other questions on this page? All right, this is the graphical way of looking at the variance between the first slide and the second slide. Again, we can see we have some better performing asset classes, but also we have some that have required our attention during this fiscal year. Interestingly, one of the things that I like to look at is how much of the portfolio is outperforming and how much of the portfolio is underperforming. And as we sit here today, there's roughly 2/3 of the portfolio on the left-hand side here outperforming the benchmark, and 1/3 that is underperforming. Our reporting team, and I think this is neat, they loaded our historical monthly returns into a system called Zephyr, which is a performance analytics software package, and asked it to generate some portfolio statistics, which we're showing here. To head off any question, the beta is the plan's return regressed against the policy return. So you can see that there's a lot of the return is coming from exactly what you would expect. I also think that a question came up in a prior meeting relating to the flexibility we have to allow the portfolio to look different. And here we see two things. First, the annualized tracking error is quite modest for a portfolio like ours. The next logical question after you look at that is, are we efficient with the use of that tracking error? So let me put that a little differently. When we allow the portfolio to look different, is that done to beneficial effect? What's the payoff for allowing the portfolio to look different? And the data here, and that is down here in the information ratio, the answer indicates, or the answer appears to be yes. And later on, I'm going to come back to this concept in a little bit of a different way.
Are those two measures skewed by our portfolio, strategic partnerships and private equity? Are we able to track those?
Kind of decompose it. This is new. We haven't gotten into the breaking this apart yet.
So I mean, that could literally be very misleading, because like what kind of information are you looking at? Individual investments from a strategic partnership, or you're looking at the partnership overall line?
This is the total portfolio. This is just looking very simply at we're loading in our monthly returns and the policy benchmark monthly return. So there's no decomposition happening beyond that at this level yet.
Yeah, but a monthly return, I mean, it's gonna be, volatility's gonna be lower than it probably is, right? But not materially, so.
Yeah,
right? You
the-
get by- You know, we have 20% in private markets, 30, whatever, so it'll have the effect of understating that beta, probably keeping that tracking error tighter, because you're doing these monthly roll forward type valuations, so the return stream is smoother than if you were adjusting your real estate every time interest rates move, like your public stuff, you'd have a much more volatile series, so I don't think it's, I wouldn't call it inaccurate, but you'd have to, the data definitely is muted, right? Volatility's muted.
Yeah, and what you described is exactly why we're not looking at standard deviation,
Yeah.
where that effect gets materially exaggerated, I think. So here we see the plan exposures as of March. Again, not a whole lot is changed here from the prior meeting. We're continuing to build the private debt and real estate exposures, and we have remained overweight public equity and core fixed income while we're doing that. This is a familiar chart. This is a waterfall. The nuance here is we turn the benefit payments into a gray box from a red box because paying benefits is not a bad thing. So we didn't want to imply that it should be regarded as such. So.
I'm all in favor of that.
Great. And it takes the plan's actual return and expresses it in dollars. This is, of course, the long form of the same thing, showing the impact of each asset class on the performance, decomposing that total plan into its constituent parts. So this is year-by-year return history. If some of you, much like myself, will have nightmares looking at remembering 2008, 2009, but you can see that the performance since then has been quite strong. This is new, so I'm gonna slow down for this. This is something that Wei Yi, who's the head of our risk team, created for us. So for the last several years, the asset allocation, as it's been contemplated by the commission, it has tended to target a return in the neighborhood, a long-term return in the neighborhood of 7.5%, and typically that's been accompanied by volatility estimates in that 11 to 12% range. So Wei Yi and her team looked at how our actual performance looks relative to those basic mean variance expectations. So let me explain what we're looking at here. The dotted line that runs through the middle of this is the 7.5% expected return. And there are two cones around that. This is one, and that is one standard deviation at 12% volatility. And the thicker line here is two standard deviations. So I think we all realize that we've been in a very low volatility environment for the last several years, and here we're looking at 5 years. But seeing it expressed in this way, to me, it was alarming just how little volatility there has been during that time period. So, as I mentioned a few slides back, the Zephyr data that our reporting team ran suggests that we've been pretty efficient at using tracking error to generate excess returns. Maybe I should pause and explain what I mean by tracking error. In order to try to outperform a benchmark, you have to be willing to look different than that benchmark. And one way to measure the degree of that difference is something called tracking error. It just describes the degree to which, if you were attempting to look like that benchmark, you would be missing the mark. So it sounds bad when we call it tracking error. It's not an error, it's intentional in our case. So here on this slide, what we're looking at is an internal goal of ours to outperform the policy benchmark by 50 basis points annually, which is the dotted line cutting through the middle of the chart. And then we have the 1 and 2 standard deviations based upon a 100 basis point tracking error target. So the cones, I think, help us understand that we're quite pleased with the excess returns we've been able to generate in excess of that 50 basis point target. And I don't know, Herschel, if you have anything you'd like to add to this, but we're pleased with our use of tracking error especially over the last 3 years, but certainly over longer periods of time. And I don't want to belabor the point, but I'm happy to take any questions. These are very different for us to show things like this. It certainly is not like this all the time, and I would not encourage anyone to anchor on this expectation.
Jeff, would you just clarify this definition of the tracking error? You mentioned it.
Sure.
It has a negative connotation, but could you just amplify on that?
Let me give an example of something. And we've recently looked at certain portfolios, and one of those portfolios was tracking the S&P 500. So if you hold all 500 stocks of the S&P 500 in the exact weights of the benchmark, you will have zero tracking, right? You will track the performance of that index perfectly. As you own fewer individual stocks, you begin to lose your ability to perfectly track that. So if your goal is to replicate the S&P 500, then you have tracking error. If you hire a manager to go intentionally not look like the benchmark, because you don't want to pay somebody 30 to 50 basis points to give you something that you could get for free, right? You want them to bring skill to the game. So if you want the manager to look different than the benchmark in service of earning you a superior return, right? We call it tracking error, but it's not an error, right? That's what you're paying them to go do. So it's just it's a quantitative measure of the degree of difference between the portfolio that you own and the index against it, which it will be judged.
Yeah, I would add that another term for it is active risk, and that gets back to what Jeff's trying to say with respect to it's an active decision to be different from the benchmark. And so what you're doing is you're measuring the volatility of the excess returns relative to that benchmark to understand that difference and the volatility of that difference. And so that's really what we're talking about. So that helps you explain how much you would expect to outperform or underperform and give you basically that standard deviation or that bell chart of what that looks like. So think about that when we talk about standard deviation at the plan level. That's on an absolute return basis. Here, active risk or tracking error is actually talking about on a relative return basis of what that volatility is.
If I can add one more thing.
Please.
Hopefully kind of connect this to some of our discussion that we'll have tomorrow. As we're looking at the return environment going forward, we'll be talking a lot about what you can expect from beta versus alpha. So this is alpha is what is basically the upside of tracking error, what everyone would like to achieve instead of the downside. When we're looking at non-traditional asset classes, such as hedge funds, private equity, real estate, forms of GTAA, those are areas that tend to have a little bit higher tracking error. So if you were looking at a program that was nothing but traditional long-only stocks and bonds, it would be rather hard to achieve a tracking error like this because the consistency of alpha and the difference that managers are from their benchmarks isn't the same extent that it is, say, in the hedge fund world or in the private equity world. So if you're looking for alpha to be a source of value added going forward for your program, it's difficult to add a material amount with just traditional long-only stocks and bonds. So that'll be one of the discussion points that we have for tomorrow as well. So I wanted to kind of connect those topics.
There are other slides in the appendix of this presentation. I'm happy to address any questions anyone has about any part of the portfolio. But I do want to leave time for Suzanne to walk us through our portfolio from HEK. Aon Hewitt's perspective. I'll get there eventually. So,
Any questions for Jeff?
No, I have one question.
Yes, sir.
And I'm not sure the best time to ask it is, but my question is, if we have a fiscal year return actually of, say, 2%, does that raise a problem relative to the 30-year amortization requirement? Or are we still safe on the 30-year retirement act, 30-year requirement?
Because we assume a 7.5% rate of return, and we're at 30 years. If we were at 25 years in the amortization period, you could weather that short-term volatility. But because we're at 30 years, then a return less than 7.5% will require a contribution increase.
So that, if 2% is realized, that would be required soon?
Well, we do the valuations with a 2-year delay. If you'll recall, last year, because of the rate of return that was generated on the portfolio last year, we did not have to increase contributions. This year, when I say this year, it would be the contribution that would go into effect July 1, 2016. There was already a contribution rate increase that was approved for July 1, 2015, which will go into effect. We delay that for budgetary reasons. So because the actual valuation didn't require a contribution increase, there's not anticipated at this point one for 1/1/16. However, because the rate of return with just a few weeks left in this fiscal year is expected to be less than the 7.5% rate of return, then when the valuations are performed this fall, there is expected that we would have a contribution increase that would be required that would go into place July 1, 2017. We do have some projections on that, and I'll be happy to send all of the commission some copies of that. It's not a material increase in the contribution rates in the short term, but if in subsequent years we don't make that up, for instance, if we have a 2% return this year, but we have a 10% net return next year, over time that makes up that loss. If we don't make up that loss, then over the next 5 to 6 years, then that contribution increase requirement would compound somewhat. But we do have some preliminary data on that we received from the actuary on the results if we were to have a 2% rate of return or a 4% rate of return for just one given year. And I'll circulate that to the commissioners, so you should have that by this afternoon.
Thank you.
Peggy, those potential contributions, do they flow directly into the fund, or?
They do. Those are employee and employer contributions. The statutes require that those contribution requirements be split evenly between employers and employees. So any contribution increase comes from the employees and the employers and comes directly into the fund.
thank you for answering that.
But I think it brings up, I mean, we've talked a lot at our strategic meetings in the past about this. I mean, a lot of focus gets put on the 7.5, but the consistency of the return has real world effects, right, that are material. I mean, kind of in a cash flow matching, asset liability matching thing. And I think a lot of times conversations around these plans, people get hung up on, the headline number, but it's not just the number, it's the consistency, of a program that have big impacts.
Well, yeah, this is gonna be a big question going forward. I mean, if you went back 5 or 6 years ago, you could have invested in treasury bonds at 10%, or, at one point, you could invest it at 15%, and it was all moot. But obviously, we're not that kind of environment. We're not likely to be in that kind of environment for quite some time into the foreseeable future. Now, everything can change, but certainly, going forward, it would appear, and we've discussed this, that the asset allocation process will be probably the most significant thing that we can do.
And the good news is that the state law adds to the solidity of the fund. The fact that the payment increases are required under law, that makes our fund more stable.
Any other questions on this subject? If not, then we can move on to A.O.N. Hewitt.
Thank you. So I just want to make sure everyone's clear on our name changes, because I know this can be confusing. So effective 1/1, we became Aon Hewitt Investment Consulting. Nothing changed. It was just a name change over from Hewitt Ennis Knupp. So you will still probably see the errant HEK in our materials. It is AHIC going forward. You can make a joke about that, a hick. But we are going forward as Aon Hewitt. So nothing else has changed other than that. I did want to take a minute to introduce Tim McHenry. So Tim, why don't you stand up real quick, say hello. So Tim is going to be working with me on your relationship going forward. As I think most all of you know, Brady O'Connell did decide to leave our organization. Thanks, Tim. He's actually up in Alaska right now fishing, taking some time to himself. He is going to be joining one of our competitors, which we're depressed about, but I think it was a small organization that he wanted to go and make his footprint. So I admire him for his choice, and he'll still be a friend, but we won't have him on the relationship anymore. Sometimes folks will say, oh, so Tim is the new Brady, right? And first, please don't do that to him. But secondly, actually what we've done internally is restructured the team. So I'm going to be spending more of a higher percentage of my time on your relationship than I was before. We were kind of splitting that duty between Brady and myself at one point. And Tim's joined the team as what we call strong second. So he's a senior consultant in the organization, has been with us for about 8 years. Has worked on other public funds, including the state of Michigan, and actually is heading off to the state of Virginia this evening, so he won't be joining us for tomorrow. And knows your area well. He's worked with Savannah Nuclear Solutions out in Aiken, and also has worked with Mary Black Foundation in Spartansburg. So hopefully you'll join him, and you'll see, congratulate him in joining the team, and you'll see him at all of our meetings going forward. So why don't I jump on into our materials. As usual, Jeff's done an excellent job and left me little interesting to say. So I will do my best. Okay, so in our, I'm going to put on my glasses here, I'm getting old. So the in our market and performance highlights, as we've talked about already, there's been a great deal of value added, but the markets themselves didn't do much to really support the long-term return expectation of 7.5%. So highlighting a lot of things that Jeff's already talked about, where we saw the big sources of value added were alpha in the low beta hedge funds, your global tactical, your global public equities, the fact that you were underweighted to two of the areas that struggled a bit in absolute return perspective during the quarter, emerging markets debt and private debt. But what hurt you a little bit, private equity, and I will spend a minute more on that. I know we already talked about that, but your relative performance in private equity did lag its benchmark, although it was strong on an absolute basis. And we are underweighted in real estate a bit, which was one of the best performing asset classes. If we look at your 3 and 5 year performance, you are in excess of the 7.5% target, but shorter term periods, not as much. You are within range. There's no problems from an SIOP basis of anything going on in the program right now. So the only reason I want to spend a minute on this is it is going to get to be a big discussion here over the course of the next couple of days. So as we look at the quarter, the fiscal year to date, the 1 year, the 3 year, the 5 year, it's worth looking at the broad capital markets and just asking ourselves what's been driving the markets, and then more importantly, where are we going to be going forward? When we started working with you and did our first asset allocation study about 2.5 years ago, you had a very high allocation to alternatives, and it was something we thought was prudent and we were very comfortable with. The question also became, was there any merit in changing that allocation to become more equity-oriented, more invested perhaps in the global public equity markets? Our thoughts at the time were that no, that had largely run its course. It maybe had the potential for another year or two of performance, but we did not see merit in moving materially in that direction. We continue to believe that, and we'll talk about that more tomorrow. If you look for particularly the 3 and the 5 year returns here, it's very clear that the place to be was the U.S. public markets. So any plan that we're looking at as a peer, the more they have in the U.S. stock market, the better they're going to look. The question mark is that going to be what helps you going forward? And that'll be a big source of discussion tomorrow, is does it make sense to look at what has done well over the last 3 and 5 years and to say, hey, that's where we should be? Or should we be looking at the markets and saying, where do we have some potential for additional run going forward. So these are exceptional, and you've largely benefited from it, but you've had less than your peers. So when we look at relative rankings, that's going to be one of the strong sources that influences things. Switching gears, from an SIOP basis, one of our roles is to inform you of anything material that's going on in the portfolio. So we do so, and we let staff know this as soon as things are going on. If there was something big, we'd come and talk to you, of course. But here are the 3 noteworthy things that happened within the program during the quarter, and in some cases shortly thereafter. So you had 2 organizations where there was a senior person that changed. Neither of them, in our view, warranted action. Both were broadcast well in advance, retirements and departures that were planned, and heir apparents that were in place. So we have no recommendations for change at either Grosvenor or at William Blair. We also wanted to alert you that our rating went up on PIMCO total return strategies. The reason that we highlighted that is because there was so much discussion last year when Bill Gross left PIMCO. You had some portfolio manager turnover. A lot of discussion on what to do with that portfolio and whether it was appropriate to leave. We had put them down to a hold after Bill Gross's departure. We've monitored it very, very closely, and we feel the total return strategies, of which you're invested in that group of strategies, does warrant a buy. So we are actually putting not only existing clients, but new monies in the PIMCO total return strategies as well. So just wanted to let you know of that, so
Suzanne.
Give you some comfort.
It would be worthy, I think, to note that the PIMCO Total Return Fund so far this year has outperformed.
yes, it has,
That's since Gross has left.
correct.
So I think we have to give them credit for that.
Yeah, they've done an exceptional job. I know that, Bill Gross is a very intelligent, insightful man, but he's only one piece in a very large organization that has an extremely deep group and smart folks. So I think they've done well. They did need to reinvent themselves a little bit, but I think they've done a nice job, and any sort of frothiness that occurred after Bill Gross's departure, we believe, has subsided. Any questions on that? Okay, great. So lots and lots of data here. This is going to be the crux of what we're talking about tomorrow, which is what are your asset allocation targets, your ranges, your latitudes, the types of things we choose to invest in. So we'll be talking about this more tomorrow. But I just wanted to highlight, of course, the kind of 5 buckets that we've characterized over time. Global equity, your conservative, kind of anchor to windward fixed income piece. Diversified credit, which is more return seeking. Opportunistic, which is very flexible by nature. And then, of course, real assets or tangible assets that have an inflation-based characteristic. We'll be talking about all those tomorrow, whether it makes sense to tweak, move, change some of these asset allocation targets at the macro level and then within those larger categories. At the end of March, you were in compliance with all of these ranges. We've already talked about performance quite a bit. This just shows it in a little bit different way. Total plan, policy index relative to your 7.5% actuarial assumed rate of return. As you can see over the 3 and 5 year periods, the total plan, of course, has exceeded that. The policy index has been a bit short. These are all net of fees, as all returns are. And then, of course, as we look at the fiscal year to date, there's a bit of room that still needs to go before we can get to that 7.5%, and it is probably unlikely that we will be able to get that. So this is something that we show you every quarter, and it's three years on the left and 5 years on the right. And we're looking here against all public plans greater than $1 billion, their risk and return qualities, and their rankings. So we want to always show you this so you're aware of it. I don't think it's a huge surprise where we are here. So we're looking at the blue box is your plan, the green dot is the policy index, and we're looking at return on the vertical axis, volatility or standard deviation on the horizontal. And as you can see in both of these, that you have a return that's a little bit less than the average, but a risk level that's much less than the average. As we move this over to universe comparisons, this is what it looks like for the 3 and 5 year numbers. They haven't moved a lot. They have been going slightly up, but these things don't move overnight. So as I said earlier, if you had a lot more in US stocks, your rankings would be a lot better. If you have a well-diversified alternatives-oriented program, You have a lot less volatility, but a lesser return. That's just the markets we've been in over the last 3 to 5 years. So we'll be talking tomorrow about whether that's where we're going to be heading for the next 3 to 5 and longer periods. Attribution, I think we've gone through most of this, just to orient people so they know how to read this chart, and then I'll just kind of move on. That top chart is how did your allocations differ from your targets? You're within ranges on everything, but you were slightly different, a percentage here, a percentage there. Did that help or hurt you? So these are going to tend to be random effects unless staff is intentionally leaned in or pulled back from an asset class. So as we can see here, as I discussed earlier, emerging market debt, for example, added 4 basis points because you were underweighted to it, and it earned a lesser return than your overall policy portfolio. So that's why it was a value added, if you will. On the flip side, real estate detracted because it was a very strong performing asset class, however, you were slightly underweighted. So that's how that works. On the bottom, we're looking at your value added within that asset class. So did your managers add value over the policy benchmarks? And you can see that in particular, hedge funds were one of the most dominant effects. Private equity detracted, and I will get to that. So if we were to look at your total value added here, almost all of it was from manager value and just a slight amount in net asset allocation. This is the same data for the last 12 months. You see some similar stories here. I would note that your underweight to commodities did add some value, which is good because that's been probably the most difficult asset class of all those that you invest in over the last year. Your low beta hedge funds were also a great source of value added, but really you see a lot of bars on the right side in this bottom chart, which is a positive, and you had 102 basis points of value added over that period. So this shows everybody relative to their benchmarks, and this is data galore, so I know this stuff is kind of hard to get through, but what I did want to spend just a minute on was private equity. So we've been giving private equity a bit of grief here, and you can see over the 1 year period, we've got 11.4 versus 11.9, 3 years 15 versus 21.6, and 5 years 14.3 over 16.6. So someone might look at that and say, hey, my private equity program's broken, what's going on, why aren't we earning great returns? What we're using as a benchmark here is a public markets return plus 300 basis points. That's a very common way of looking at the overall private equity markets. It's basically saying, hey, I'm giving up liquidity, I'm taking on maybe some more risk, I should earn some extra return over the public markets. But it's hardly higher math. It's not a, you can't go out and earn that return anywhere through an index fund. It isn't really reflecting what private equity managers are doing.
You could with leverage.
You could.
I think that's a fair question because your
Yeah.
private equity guys are putting leverage. I mean, a big part of private equity's been buying a public company and putting more debt on it
That's a good point.
than they
I never
would
thought
as
of
a
it that
public
way, yeah.
company, right? I mean, you absolutely could wall it off.
Right, you could create that sort of a return stream.
Absolutely.
It's a good point. You can't go out and invest in private equity,
Right.
passively. The point I was trying to make, though, is remember that chart we were looking at earlier and where the biggest returns were coming over the last 3 and 5 years. And you saw that the stock market was where everybody's getting the highest return. In periods like that, it's very, very uncommon for private equity programs as a whole to earn 300 basis points on top of that. I've yet to see a private equity program among our public funds, or really any public fund out there, that's earned a return in excess of the public markets plus 300 over the last 3 and 5 years. So I'd counsel a little bit of patience on the peer comparisons there. We'll talk about internal rates of return in a minute, but just keep in mind that that's a very, very difficult benchmark to outperform. It's the benchmark you have. I'm not giving it any sort of, too much of an excuse, but just to give you some context that very few folks have earned that sort of return.
Suzanne, just one question. When you
Yes.
talk about the public market plus 300 basis points, typically the index or the benchmark you use for the public equity market would be, for instance, the S&P 500 in the case of public equity?
In this case, we're using a mix of U.S. and non-U.S. indices to reflect that your private equity program does have a non-U.S. element to it. So that's typically what we do. Many years ago, it used to be just the S&P or the Wilshire 5000 plus 3000, but best practice has been to incorporate a non-U.S. component to reflect that. We have seen people starting to revisit the private equity benchmarks because this has gotten to be a very big issue in public fund boardrooms around the country, because public funds are often using performance-based compensation, and the private equity programs have been a real drag on performance, even when they're performing very well, because of this way of benchmarking. So we do have some clients that have been looking at different benchmarks, and that's something we will be talking with staff within the next year to see if that makes some sense here.
But isn't that the benchmark, the genesis of it, to try to reflect some of the inherent risk that is not captured by any measure we have in the underlying portfolio companies? I mean,
Yep.
there's leverage at multiple places, not counting the currency, political risk, custody risk, and all the other stuff.
Sure.
So I mean, it's inherently a risky class.
Yep.
So why wouldn't you have a high benchmark?
Oh, there's nothing wrong with it being a high benchmark. The question is it a good benchmark? So it measures different things. There isn't a perfect benchmark in private equity. So what I would say stock plus 300 equals is a way to look at, did this asset class add value for me over the long term? Because I could have invested in the stock market. I'm taking on additional risk to be in this asset class. 300 is the number I've chosen. Was this a good decision or a bad decision? And so that's the way a lot of people will look at it. It's more the asset allocation decision and less about, we've made this decision to invest in private equity. Are we good at it or are we bad at it? So if you're looking at it that way, then I'd say a peer benchmark makes more sense. So looking at it relative to other private equity programs, did we do well, did we not? So there's kind of two different ways to look at benchmarking. And so a lot of our clients will do, and this is something we'll do in the next year, looking at how well did we do both as a decision at the macro level, so this asset allocation decision, is it adding value as a piece of our asset allocation mix? And then two, are we doing a good job in manager selection within the asset class? So that's where you get to peer comparisons being a good kind of secondary benchmark. Is that helpful, or did I go too far off the deep end here? Okay, so we had talked about internal rates of return versus time-weighted rates of return. Jeff brought up this topic. It's a fun one. So in the private markets world, we think of internal rates of return as being a better way to really understand the value added by your managers. So think about it this way. When you're investing in private equity, you've decided to commit $10 million to a partnership. They will take 5 years or so to draw down those dollars as they find good investments to make over time. Probably at no time will you actually have $10 million with them, because before they draw down that last dollar, they're going to start selling off, getting rid of your investments, and returning capital back to you. So the reason we want to use internal rates of return for those types of investments are they reflect that the return you earned in that first quarter, which may have been on very little capital, doesn't have the same impact as the one you earned in year 5, where most of your dollars were at work. It's looking at how much did you have invested, when was it pulled down, and how much impact did that return have on your total return stream. So this is a true reflection of the impact that it has on the fund. So we like to, yes.
Can I just ask a question? Again, when you get the significance of the internal rate of return in relationship to the ultimate return of cash you put in versus cash you got out.
Mm-hmm. Yep, exactly.
Now, wouldn't that indicate that maybe that you can be misled at some point, or the internal rate of return is, at any given point, might not be entirely accurate? Or am I missing something?
So where it might not be accurate is when you have, well, think of it this way. In private equity, everything's an estimate until you've sold. Same in real estate. So they're going to generally do more conservative valuations. We don't see managers making choices to be aggressive on their valuations unless they have really good reason to be. So usually they're underestimating until there's an actual sale. So there's that element of estimate, but that may not be what you're speaking to. Is that answering your question?
I guess I'm trying to get to what is when we talk about rates of return, is it the actual rate of return of what we put in and what we actually got out, as opposed to any given point, which could be defined as internal rate of return? Am I confusing.
Okay, so the difference between internal rate of return is this is more dollar weighted. So think of the periods where you had just a little bit invested, doesn't have as much of an impact as the periods when you had a lot.
Right.
So this is more of a reflection of how it really helped or hurt your fund. The time-weighted rates of return, which we just looked at a minute ago, and how your other managers are weighted, is we count everything basically the same. We're linking quarter one with quarter two, with quarter three, with quarter four, and we're averaging them. So that's fine if you have a $10 million investment that generally is staying around $10 million. It's not fine when you have a $10 million commitment that may be $100,000 in quarter one, $3 million in quarter two, $10 million in quarter three, and back down to $2 million in quarter four. You don't have that level of volatility, but you can imagine you can't link those four returns together and really understand the impact it's going to have on the return. That's where an internal rate of return helps you. Is that
Yeah,
getting
I
at the issue? Okay, so we call this a lot of times dollar-weighted returns as opposed to time-weighted returns.
But aren't, I mean, I've done a fair amount of reading on the IRRs.
Yeah.
And, you know, you get, the industry says, yeah, we love it. You go over to the white papers from Harvard, Yale, and Columbia, those places, they say, whoa, if you want to game something, that's the easiest thing to game. And they talk about how we've done it there. We've aggregated multiple funds in vintage years all into one and came up with this 11.38 IRR. I guess that's how you've done that, right? The
Well, no,
private debt?
every single fund is looked at for their own, so we basically pull it all together
Yeah.
and calculate it.
And over what period of time were those funds and the differences of
Right.
those funds? I mean, it's a high-level look, and it's isolated with one not truly return because you haven't realized the money. I mean, a lot of it's just a lot of their plan.
Well,
So-
some of them are realized, some of them aren't. That's a good
I mean,
point.
let's just say, I think very few of us, if this were our portfolio, if it was my portfolio, if it was Ed's, I wouldn't look at it that way. I
Okay.
would look at it differently, and because if it was my money and I had to pay the bills.
Yeah, I would add that, let's kind of take a step back. Internal rate of return, net present values, these are all very well-established principles throughout corporate finance. If you're evaluating, forget about investing in private equity. If you're evaluating taking on a project, you're going to use a net present value IRR type exercise to help you make that decision. So the concept of IRRs, net present values, multiples on returns, that's not just private equity. That really actually stems from corporate finance.
More
And
used
so-
there than.
And no, it's very, very common practice for this because you're having the exact same principle applied. You're making the decision of investing a cash flow, and then there's a decision of when those timing of those cash flows come back as well. And so the whole idea behind the IR is to say, this is the discount rate that would get you back to making those cash flows equal zero.
Right.
And so it's a discounting mechanism to show you what you would have earned to make that.
I understand that, and I certainly, this is the problem with how the commission needs to set up. Like the people tomorrow, they will be more than happy to echo that. But there are significant people, 10 times more than I am, who will argue those points all day long and are credible and are well recognized in their fields. So I just think we have to be careful because this, again, takes away much of the specificity of it by how we've aggregated large and disparate groups with different time frames and different risk sets into a couple of simple numbers on the end.
Well, I think that's a huge point. I'm trying to keep this as simple as possible, but it is by no means a simple exercise. So one of the reasons that some people choose not to invest in alternatives, particularly private equity, is it is complex to monitor and measure. There is no single metric that I can say you're good or you're bad at this. It has to be looked at from a lot of different fronts. So I hear exactly what you're saying. I'd be interested in the article. Please send it to me. I'd be happy to respond to it. But I would emphasize that this is considered best practice in looking at private equity is to look at it on an internal rate of return basis, to look at what sort of cash you've received for the investments you've made. So you said earlier, hey, we've got appraisals in here. Let's take that into account. Okay, great. DPI is what's been distributed. What cash have I gotten back versus what I paid in over time? So you're getting very close to 1.0s and higher, which is huge, given that you haven't had a very old program. You've been getting back a lot of cash for the money that you've been putting in over time. And you have a great deal of unrealized gains in there as well. So the two things, and that would be the TVPI. So that's how much is my value at this point, including distributions and what's remaining in the portfolio at its current, probably somewhat conservative valuation. What are we looking at here? So that's one way to look at it. We don't have it in here, it's in the, I'm not gonna go through it for sake of time unless folks would like us to. But we do think it's important to look at it by vintage year as well. So that's something, the year in which your investment was made. Newer investments are notoriously flippy in terms of their valuations. You'll get some that are marked up right away, you'll get some that are marked down right away because they haven't been working out. You have fees coming out in the early years. So oftentimes, young investments have very poor returns. And then it's in the later years that they earn their better returns, sometimes called the J curve. So it's more, you also get more stable returns as you look at older investment pools. So you know what, let me just look at one. I'm not gonna go into all of this, but we have our private markets portfolio summary here where we go into detail on all of this. So just to kind of anchor everybody. Here-
And these do include all strategic partnerships?
It does.
The private.
And I'm glad you raised that, because actually at the November meeting, we're gonna be doing a more comprehensive report on your strategic partnerships. Also, in our private markets review, we're gonna start showing line items for your strategic partnerships performance. So you can say, hey, how's Apollo doing as a group? Challenge there's benchmarking, because they do have different things they do within there, but we'll give you some very clear information on that. But yes, we look at any private equity investment made, whether it was through a strategic partnership or as a standalone within the program, the same way for benchmarking purposes. So let me just dig in for a minute, just so you can see how this looks. So this happens to be private debt. So we have one of these for private debt, we have one for private equity, we have one for real estate. All of your asset classes that are privately valued and therefore have some challenges on benchmarking. So here, in terms of private debt performance, we do show it by vintage year. So if you look at the far chart, we're looking at the year in which the initial investment was made. How many commitments does that represent? Because sometimes it's only one, and so, you know, the law of large numbers here. What was the dollar amount committed? How much has yet to be drawn down? How much has been drawn down? How much have you gotten back? And what's the remainder worth at this point? So you can see, if you take those last two columns, distributions and net asset value, you get that total value. Potential market exposure is if everybody pulled down every dollar at the same time, what would we end up with? That never happens, but we like to show that to you just in case that ever was the situation. And then DPI, again, is what's been distributed versus what did you pay in. RVPI is what's remaining versus what's been paid in, and then TVPI is the total value, distributions plus things that are remaining in the portfolio relative to what you contributed. Okay, and then we have a net IRR. Remember I was saying sometimes those young IRRs can be misleading? Look at 2013. So 96% IRR, fantastic, that's great. I would love to see that continue. It probably won't, it'll probably regress. However, I think you've got a very strong set of returns here for, you know, even things back in 2007, which was a really challenging year to be making private debt investments. You've got double-digit returns across the board here. And then we break it out by the types of investments that were made. And this is without regard to the year in which they were made, but trying to look at the different ways that you make investments in private debt and how have those done. There's different risk return characteristics across the board here. And you can see a couple that maybe draw your eye, such as energy, but that's a single investment that we've got there. But many of them are in the double-digit area as well. And you can see it's dominated by opportunistic and distressed to the areas that have done very well for you. We've got some information in there, and then we go into private equity. So we have the same information here for each of your main asset classes in the illiquid space. As I mentioned earlier, in November, we will be doing a more comprehensive review of all of your strategic partnerships. So it'll be looking at what are they doing for you, what are they invested in, how have they performed, and what is an appropriate benchmark for them. So we're working on that now. It's a big report. So that's why it's going to be a November report instead of a September. But it is something I think will give some additional color to that. And so as a reminder, we produce a full private markets report every quarter that does contain information on each of the underlying managers as well. Since this is a public meeting, we've aggregated the information here, but the commissioners have access to the more detailed report that goes into detail on each of the managers, strategic partnership or no. Okay? It does have the co-investments in there as well. I know there was a discussion about that earlier. Are there questions on this? Because I can go into a little bit more depth. I don't want to get us behind on the meeting, but had enough.
I'll say, I do think it's worth noting with respect to the evaluation of private equity managers, that part of the analysis that we actually conduct is also a public markets equivalent. And so that's thinking about the opportunity cost between going private or public. And so what you do is you align the cash flow allocations as if you invested in public markets, and then you compare those returns. And that helps you get an idea or a sense, would you have been paid to take that liquidity risk relative to public markets? So that is one part of the analysis that I think gets at some of the questions you had with respect to, is IRR the best measure for these? So that is one part of the analysis we actually conduct for managers too.
There's just no single benchmark, unfortunately, in the private markets, particularly private equity and private debt. Real estate's a little easier to benchmark, but there's real challenges in this space.
Suzanne, do we have any idea, for instance, the Yale portfolio, which is exclusively alternatives, what kind of methodology they use, and they've been obviously quite successful?
In terms of performance measurement, or in terms of the types of investments they're making?
No, the performance measurement.
You know, it's a great question, and I don't, we actually have David Swenson on one of our other clients' investment committees, and I know that one of my colleagues is very knowledgeable about what they do there. I don't know off the top of my head, but I will get some information for you and report back.
I mean, they've reported, something like a 21% rate of return over a significant period of time. It's all very heavily in alternatives, private equity and so forth. It'd be interesting to know how they do value that.
Yes.
And if it's as good as they say it is.
Extremely opportunistic group overall. So really not focused on policy allocations as much, and I have a great deal of latitude afforded to staff to make investments that they see are interesting. But we can certainly get some information together.
Be interesting to know that.
Other questions? Great, that was all I had.
The next time on the agenda, Mr. Chairman, is executive session.
We need a vote to go into.
Yeah, move to go into, maybe take a
All right,
quick break. Yeah.
need a motion to go into executive session?
Mr. Chairman, if I could just
Go
note
ahead.
that the reasons for going into executive session would be to discuss investment matters pursuant to SC Code Section 9-16-80 and 9-16-320, to discuss personnel matters pursuant to SC Code Section 30-4-70, subsection A1, and to receive legal advice from legal counsel pursuant to SC Code Section 30-4-70, A2.
Motion to go into executive session?
So moved.
Second?
Second.
All right, we will take a 5-minute break.
All in favor?
Oh, I'm sorry. All in favor? Aye. Any opposed? All right, we're going to executive session. We'll take a 5-minute break. And who do you want to stay?
The
Ladies and gentlemen, we're now back in public session, and we're now going to go to item 7, investment items, private equity, and David Haas will make the presentation.
Recommending a 100 million Australian commitment, which is approximately 80 million US dollars today, to Pacific Equity Partners Fund 5, with a separate 50 million Australian commitment, or $40 million US, for additional allocation to co-investments. The co-investments are expected to be no management fee or no carried interest. Pacific Equity Partners expects there to be co-investment opportunities in this fund. This gives us the opportunity, but not the obligation, to participate in those. As you can see down at the bottom, fairly standard terms: 2% management fee on committed capital during the investment period, 1.75% on capital, invested capital thereafter, a European waterfall with clawback, so 20% carry, 8% preferred return with 100% catch-up. The one thing that is different here, it is a 6-year investment period from the first close, which was last July, as opposed to what we would see more standard would be 5 years from the final close. But fundamentally, they end up roughly being about the same time frame, so no real concern there. As noted at the bottom, Aon Hewitt has rates this fund a buy. And when thinking about Pacific Equity Partners, they look to acquire underperforming market-leading companies in Australia and New Zealand. It's important to note this is not a turnaround strategy, but they're buying companies that are underperforming, and doing well, but not as well as they could be, as opposed to a turnaround situation.
Okay, David, just
Yep.
before you go, what's a European waterfall?
So European waterfall is a waterfall structure that, as opposed to offering carry on a deal by deal basis, rolls all the investments together, and so you can't make a distribution of carry until all the preferred return and the capital has been returned. And so that's what a European
opposed
waterfall is.
to-
As opposed to on a deal by deal basis, where you'd be, if one company got sold, you could see a carry going out the door, even potentially when the other companies are unrealized.
Is that common,
So
among?
that would be more the American waterfall. That was more common probably in the 80s and 90s when private equity got started. I think more recently, the European waterfall is the standard, and certainly is the standard by which the ILPA, which is probably the main industry kind of trade group, has been pushing things. And so other than perhaps some of the early stage venture capital managers on Sand Hill Road, most people have gone in the direction of the European waterfall. And it's certainly better for us because we get all our capital and all of our preferred return back first. Good. So PEP is based in Sydney, Australia. Was founded in 1998 by 4 partners. They had worked together since the early 80s in various consulting roles, most recently at Bain & Company. The first fund was actually a joint venture with Bain Capital, and all subsequent funds were raised independently. And today, Pacific Equity Partners is the largest private equity firm based in Australia and New Zealand. As I mentioned, 4 founders are still with the team today in various capacities. Underneath them, they have 3 other managing directors and 4 directors, most of whom have grown up within the firm. And of the 7 managing directors, 6 have prior experience at Bain & Company, so there is that heritage there, and that certainly fits well with the toolkit that they use to evaluate and create value at their portfolio companies. I think one thing that is important here is this bandwidth. They have significant bandwidth today. They only have 4 portfolio companies across their funds, 2 of which do not require a lot of time, meaning one is public, one is about to go public. So they really have 2 portfolio companies, which means they have the bandwidth across the team to source, underwrite, diligence, manage, and add value at the companies here for this fund. It's something that you don't see very often with a Fund 5, where there is that small embedded portfolio, but you might see with a new fund or a spin out. So it's certainly something that is attractive. And finally, in terms of investment, they've put $5.7 billion to work in their first 4 funds across 23 platforms, 17 in Australia, 5 in New Zealand, and 1 in the U.S. The one in the U.S. Looks like an outlier. It was a complementary business to a deal that they had that was based in Australia, and that is why they did it separately. Going forward, they've indicated they would be unlikely to do something outside of Australia and New Zealand like that again. So, the key thing here is, what is an underperforming market leader? That was one of the 4 things we highlight here that we liked about Pacific Equity Partners. And fundamentally, they're companies with strong business positions, sustainable competitive advantages, operating in well-defined markets that are not being operated to their full potential. And these market leaders can often be found within PEP's middle market mandate, with enterprise values ranging from 200 million Australian to $1 billion. And research by Bain & Company, not surprisingly, indicates that 50% of market leaders underperform relative to what their achievable return on capital could be. So that's the market segment that they're targeting. As I mentioned, point 2, strategic capabilities drive upside. They are ex-consultants, and so they are very hands-on with their portfolio companies, not running the companies on a day-to-day basis, but providing their management teams with supplemental resources combined with strategic and tactical guidance. They focus on value creation opportunities such as operational improvements, management team enhancements, and strategic add-on acquisitions. And their approach to acquiring businesses is to look to potential transactions to satisfy sellers and or companies' needs through structures. The 2 structures they tend to use most often are either corporate carve-outs or public-to-private transactions. Corporate carve-outs are interesting. They tend to be more complex as a result of shared services such as supply chains, HR, information systems that don't come along with the new business, so they need to be created as part of that spin-out. And then the sellers are using this to sell underperforming or non-core assets. And ultimately, the value potential is greater for the buyer because of this complexity. There's not as many likely buyers, and the valuations are typically lower. And at the same time, the buyer is able to reinvigorate a business with fresh capital, people, and ideas. And for Pacific Equity Partners, I would think Australia and New Zealand, things can be non-core just because they're in Australia and New Zealand. So you have a business, a multinational corporation, it's remote, far away. That can be enough of a reason for multinationals to be divesting, and Pacific Equity has been active in trying to source those type of transactions. Public to private transactions would be the second one. Certainly the market in Australia and New Zealand for public companies is decidedly smaller cap, and so there are opportunities for PEP within this market. Again, it's a leveraged buyout transaction where they're delisting the company, and then the couple of things that they look to do. Obviously, when you're not a public company, you can focus on the long term as opposed to quarterly earnings horizons. And then secondly, it can be a catalyst to eliminate suboptimal ownership and capital structures and replace incumbent management teams. And that's all things that PEP has done successfully in the past. And then finally, the Australian-New Zealand private equity landscape is attractive, and PEP has a good position within that. As I mentioned, they're the largest player. The market is an established private equity market, established rule of law, established capital markets. Middle market is relatively less competitive to what you would see in the US or Europe. Other developed markets, there's really two competitors. One is called Archer, the other is Champ. And clearly there is some competition coming from both global players and Pan-Asian private equity funds. Those are typically for larger transactions, and their activities and returns in the region have not proven to be consistent, and so they tend to come in and out of the market. Continuing on that, this does provide us with differentiated developed markets exposure relative to what we have in the U.S. and Europe, where 90% or more than 90% of RSIC's private equity exposure is today. You have Australia with an economy that has grown unabated for 20 years, population that has grown roughly 3% per annum, and probably the strongest banking system in the world with four of the six most highly rated banks from a large cap perspective. When you look down into the details, our private equity exposure in Australia and New Zealand is under $10 million today, so very small. And then when you look at it, from a plan perspective, our exposure to the market is less than 1%. When you compare that to the MSCI All Country World Index, which is a common global private equity, public markets index, you see we're well under that. And even if we were to be fully invested in PEP, we wouldn't even come close to having that level of exposure. And finally, as our fund of funds exposure continues to decline, we're looking to add exposure in our private equity portfolio to buyouts, which this does accomplish. From a returns perspective, the first here is a benchmarking against Cambridge Associates data. So this is peer benchmarking, primarily first quartile, across all their funds, other than the IRR in Fund 4, which is second quartile, and the multiple of invested capital in Fund 1, which is second quartile. So very strong performance here. I will note that PEP's numbers are as of 3/31. The benchmark is of 9/30/2014, as those marks are for the year end are just coming in today. So there is a little bit of a time lag there, but would not expect that to have a material impact on this analysis. I think separately, Precon, which is another data provider, recently named PEP one of the most consistent performing private equity funds in the world, and the most consistent performer in both Australia, New Zealand, and Asia more broadly. The second analysis is a public markets equivalent analysis, which is trying to take a look at the inflows and outflows that PEP had, and what would happen if we had put them into certain public market indices over that time period. And as you can see, there is outperformance both against the ASX 200, which is the Australian Stock Exchange, the 200 largest companies there, and against RSIC's private equity benchmark. So again, strong performance here, and comfortable with that level of absolute performance, and that they will continue to outperform going forward. In terms of some of the things we thought about as we were looking at making this investment, one of the biggest thing was the Australian economy and the potential link to China there. I think as you think about the Australian economy over the last 4 or 5 years, there has been a significant investment in natural resources and in mining. That is starting to subside, and it's going into more of a harvest or exploitation period. And certainly, as that happens, 2015, 2016 are viewed as potential challenging periods for the economy. I think of note one, the Australian government has, policy bullets to implement, unlike most other developed nations, to address those issues. And two, as it relates specifically to China, only about 5.5% of Australia's GDP comes from China, so smaller than what you would otherwise expect. And so, comfortable with that. And then finally, look, as I mentioned, they do have a relatively small embedded portfolio. The two companies that they do have in the portfolio, both companies, more than 50% of the revenues are from outside the region, so it will not be a huge impact on either of those companies, and I think there will be opportunities for them to buy businesses on an attractive basis during that time period. Number two, they had to write off 2 investments in the retail sector during global financial crisis. And I think, the result of that is, at a high level, they're not looking to do traditional retail investments going forward, as they think it is a rapidly changing market. And certainly they shifted gears and really focused on those corporate carve-outs and public-to-private transactions since the global financial crisis, where they've done 5 deals. They've resulted in 35% IRR and a 2.5x multiple of invested capital. It's important to note there that 4 of those 5 transactions have been fully or substantially realized, and 1 is public, so those are, largely actual returns as opposed to, paper returns. And the last thing, they've added an additional layer of review outside of the core deal team, such that the other members of the senior management team are actively focused on reviewing some of the transactions, such that they can make changes based on management and our business trajectory in a quicker manner than they have previously. And finally, they do have a history of some cross-fund investing. A lot of that was done where they were looking to do a strategic add-on acquisition for an earlier fund that did not have additional capacity remaining to do it. They were very formal and transparent with the process and sought advisory board approval and independent third-party evaluations where necessary. Aon Hewitt and RSIC operational due diligence reviewed and found no issues. They do have a stated desire not to do cross-fund investments going forward, and that is why they're actually looking for co-investment capital for this next fund. And in fact, in their largest transaction in Fund 4, they used co-investment capital. So in summary, looking for a $100 million allocation to PEP 5 with a separate $50 million allocation for co-investments. Have conviction in this manager, and look forward to working with them.
Questions for David?
Only question I have is still just the logistics or, kind of insight on the co-investment, given that this is a foreign manager.
Yeah, I have gone through a co-investment process with the manager before, did not ultimately, in that transaction mentioned, did not ultimately make an investment there. And so what I would say is they certainly gave us the time and the information that we needed, ability to speak with management and do some of our own work. Obviously, that's not going to be necessarily on site in Australia, but in terms of their ability to provide us with that situation, with the information, the access to the people and the deal team that we needed, that was certainly there.
Yeah, so that's key. It would be as opposed to on-site visits in Australia, which I'm sure David would love. It would be more telephonic.
I'm going in a shipping container from the port, so.
So, but I do think that, with that said, that Aon actually had a resource in Australia, I believe, that actually, yeah.
Anything else? Not, thank you, David.
Make a motion, Mr. Chairman.
I guess we need a motion to approve. Second? Any discussion? Hearing none. All those in favor? Aye. Opposed?
Right.
All right, 4-1, okay.
Next would be Highbridge.
Highbridge Sand Lapper Credit Fund, and Adam is going to present that.
Thank you, Mr. Chairman. Our recommendation today is for a $400 million commitment to Highbridge Principal Strategies for a multi-strategy private debt account. I want to open by thanking my colleagues Steve Marino, Eric Pravelli, and Alexander Campbell, who worked very hard on this with me, and because of their hard work, you see a better product in front of you today. We're going to talk a little bit about why the strategy is a good fit for our private debt portfolio, and then why we think a fund of one is the right implementation methodology for this strategy. And then we'll speak briefly about the due diligence process, then Highbridge, the firm, and the strategy that they recommend, the investment rationale and some of the risks around it, and finally just touch on the guidelines that we're recommending. So as I mentioned, we are recommending a $400 million commitment to Highbridge Principal Strategies within our private debt asset class. We are recommending a fund of one structure with no leverage and a 3-year commitment period with recycling after that. RSIC can discontinue the mandate after that 3-year investment period at our discretion. This is modeled loosely after our existing fund of one with GSO. The fees on this are 85 basis points on invested capital, 12.75% carry over 7% preferred return with an 80-20 catch-up. We will pay actual expenses, actual ongoing expenses to support the fund, and there's a 3-year rolling clawback window. Just anecdotally, I'll say I believe this is one of the best, if not the best, fee structure in our private debt portfolio, and we'll talk about that in more detail later. And the custodian is Bank of New York Mellon. Aon Hewitt has indicated their support in an accompanying memo. So as you look at the private debt portfolio, I've broken out the subcategories, the sub-asset classes here based on their target net yield. And we start at the bottom with our senior lending strategies, the lowest yield of all with expected returns of 6+%. You go up through mortgages, then this multi-strategy mandate, mezzanine, distressed, and opportunistic. If you look on the left-hand side, you can see where our recent commitments have been, primarily in the senior lending space, the lower target yields, and then on the higher end with our opportunistic and distressed strategies. And this is a barbelled approach that we've taken, and what we're trying to do is fill this gap in our portfolio right here at this 10% net yield target with the multi-strategy mandate. We are currently underweight 1.5% to the policy target for private debt, which is 7%. So we're roughly $450 million below target. We believe this is an asset class where we want to be at a minimum at target. So we're working to get to our target level. We work with HEK on a pacing model, and the equilibrium pacing for private debt to get back to target eventually is about $600 million a year. You can see over time we've been very dynamic with our pacing in private debt, reacting to the market and what we've seen in credit overall. We're recommending going higher than that equilibrium estimate of $600 million a year this year to get us to that target more quickly, but not outside of the historical bounds of our pacing in this asset class. Let's speak just a second about implementation rationale. So if you think about the two different types of funds that come before you, they're the traditional commingled funds and then the funds of one, which have various flavors to them. And I've listed the pros and cons here, many of which you're familiar with. I want to stress just a couple ones for this mandate. With this fund of one, we believe you can access this market with a potentially much lower fee structure, have more control of fund level liquidity, and reduce the market timing risk and improve the manager's ability to be tactical. You do take on some more manager concentration risk, but we believe that with a high conviction manager like Highbridge, that's appropriate. Now let me stop there before I get into more specifics about Highbridge and see if there are any questions about the private debt portfolio or the structure. Okay, if not, we'll move into the mandate more specifically. We went to the market and we were looking for firms that had the overarching theme of a very broad funnel. So one of the managers that were seeing a lot of deal flows, lots of opportunities, and had capabilities across asset types, different industry sectors, up and down the capital structure. And so we always look for teams with a strong investment process and then the desirable economics and alignment of interest. And so with those themes in mind, we went to the market and we selected 6 of what we believe are the largest and most highly respected private credit firms in the space. And because of the size and the bespoke nature of this mandate, We utilized somewhat of a different approach. We worked with Aon Hewitt in developing an RFI, so we sent that out to the marketplace to level the playing field for information gathering. We set out some broad parameters for the managers and said, you tell us how you would achieve a 10% net return. And we utilized a scoring methodology that we think brought us to a method for reducing that level from the number of managers from 6 to 4, ultimately performed on-site due diligence with 4, and then developed our final ranking and consensus plan, which is before you today. So we'll speak more specifically about Highbridge Principal Strategies. Highbridge Principal Strategies is an ultimate subsidiary of J.P. Morgan Asset Management. And it's a direct subsidiary of Highbridge Capital Management, which was founded in 1992. J.P. Morgan purchased a majority stake in 2004 in Highbridge Capital Management, and the Highbridge Capital Management formed HPS in 2007 for its non-investment grade credit platform. It's been led from day one and continues to be led by its 5 founding partners who all work together at Goldman Sachs. The CEO is Scott Kapnick, who was the co-head of global investment banking at Goldman. So what we've illustrated here for you is the platform for Highbridge. They have 3 primary offices, one in New York, one in London for the European-based team, and one in Houston for their energy team. And we've broken out their strategies in private credit and public credit, equity and total. The difference between the two is where they employ leverage in some of their strategies. But you can see their platform is rather large at $20 billion in total equity. The majority of that is in private credit, mezzanine, and direct lending, and then their opportunistic liquid strategies. They have over 70 investment professionals, and they've had a pretty rapid growth rate. They started with $2 billion in 2008 and have quadrupled, actually quadrupled since 2010, and started with 20 investment staff members, now have over 71. So there are 3 primary reasons why we chose Highbridge for this strategy. One is their differentiated sourcing model. If you think about the managers in this space, most of them use private equity sponsors for sourcing. So they participate in deals that private equity sponsors bring to them. Highbridge seeks out and participates in non-sponsored deals. It's a more inefficient sourcing channel, but they believe that it allows you to achieve better spreads at the same risk levels because it's less competitive. So that's unique about Highbridge. More than 80% of their deals in 2014 did not have a private equity sponsor involved. They also have the minimal amount of conflicts relative to their peers. They have relatively few competing pockets of capital. It's more of a pure play credit platform. And for us, we felt like this allowed us to be treated in the best way possible from an allocation perspective. And finally, we were very impressed with their team. It's a highly integrated and credible team. They have an open architecture design for their business. There are no walls and no silos within the organization. A very robust investment committee that approves every deal, every private credit deal, unanimously. They do have a strong return track record in addition to their AUM growth. And their proposal was to blend direct lending strategies, mezzanine strategies, and liquid opportunistic strategies as they come along. So we assessed their performance and their risk profile, and 3 themes came out from that. One, which I think is really important to stress for a credit manager, they've had 0 losses in private credit since inception. 0 losses. So there are many managers with good track records. Nobody has a better track record for losses than 0. And they've had solid absolute and relative returns. And what you see here is a breakout of their direct lending strategies, the first mezzanine fund and second mezzanine fund. These are the gross and net returns for each of those. If you're thinking about how we would look in this scenario, our fee structure is much more advantageous than these, so our returns would actually be closer to the gross than the net in these instances. When you think about relative rankings, this is a second quartile fund, this is a first quartile mezzanine fund. They don't do quartile rankings for direct lending funds, but based on our experience, those are very attractive returns. We also believe they've achieved these returns with very low risk levels. As we peer through to the portfolio and look at how they've achieved these, they've done these with relatively low leverage levels. There are 2 primary risks that I would like to note relative to Highbridge. One, it is the smallest platform of the 6 managers that we looked at. And we did go to the biggest players in this space, but Highbridge is the smallest. We're comfortable with that for a couple of reasons. One, they're still large enough to lead transactions to achieve those upfront economics that are critical in this space. So they can lead deals and get the upfront fees that are important to enhance our returns. And second, it's important to note their AUM growth rate. While they are the smallest, they certainly have the steepest curve when it comes to AUM growth. And so we felt like those 2 mitigants address the platform size. I think more importantly, the ownership structure and the key person risk here is something worth noting. I would say that their ownership structure is less than optimal, and they're part of JP Morgan. And the key mitigant from our perspective was that this fund of one structure allows us to unwind it after the investment period at our discretion. So we have maximum flexibility that you can build into these types of arrangements relative to, say, a commingled fund. And I do want to note that while we could unwind the structure, we would still own the assets. So these are illiquid assets. I want to be clear about that. I've put in front of you some of the guidelines. I won't go through each one of them. A couple things to note. These fund of ones, as I mentioned, come in different flavors. For this, investment commission staff has no discretion. There is no consent process for deals. The manager has all of the discretion. The only area of discretion that we're asking for here is on the pacing. What we've set forth is essentially a 3-year pacing plan to put this money to work to avoid vintage year risk. We are asking for any deviation from that to be approved by the RSIC CIO in the instance where the market shows us a great opportunity and we want to put more capital to work with this manager. So other than that, these guidelines are relatively standard in what we see with some other commingled funds and what we have with our existing credit fund of one relationship. There is no leverage, as I mentioned, but we will allow currency hedging at our discretion in this portfolio. I mentioned the fees earlier. What I've laid out before you here is a sampling of the fees in our private credit portfolio. The x-axis is the management fee, the y-axis is the carry. We want our managers on the lower end here. And as you can see, Highbridge is in this lower left corner, which is exactly what we're looking for. This is a broad range of managers. These are some that are on our platform, some that just are inbound inquiries. Some of these are vintage 07, so this is a wide, we've accessed a lot of different funds for this. You can see the average here. But again, I think Highbridge in this strategy is one of the most attractive, if not the most attractive, in our private debt portfolio. So in conclusion, we have a high degree of conviction in Highbridge principal strategies. We think they'd be a valuable addition to our private debt portfolio. Happy to take any questions.
Adam, what sort of returns are you targeting on this?
10% net. And that's the gap in our private debt portfolio. If you look at where the other managers are playing on an unlevered basis, that's the hole that we're trying to fill.
And what's the length of the investment?
A 3-year investment period, and then after that, they can recycle. We hope this grows to much higher numbers, but that's at our discretion. Evergreen, right. Compare that with a commingled fund that would have, private debt, 8 to 10-year life potentially.
Does Hybrid have skin in the game on this one?
They do. The manager will commit, I think it's 0.2% as part of the legal structure. They also have $129 million of personal capital in their funds in which we'll be investing alongside some of their assets. So of the 5 founders, they have $129 million of their own capital in those same assets that we'll be investing in.
Questions? Any more questions? No more? If not, need a motion to approve the Highbridge investment as the motion is spelled out in the packet. Do I have a motion? Second? Was there a second?
Not yet.
Not yet.
I'll second.
Motion has been made and seconded. Any further discussion? If not, all those in favor? Aye?
Aye.
Aye. Opposed?
Yes. 5-0.
It's unanimous. Okay. Who's giving the next one?
The next one is Golden Tree.
Golden Tree, who's that?
It's Marina. There he is. He's up there. Yeah, he's up there.
Okay.
Wow.
All right, next is Golden Tree. Mr. Marino.
All right. Good afternoon. This afternoon, I will make a recommendation for up to 4% of plan assets in Golden Tree Asset Management in a structured credit mandate. Let's see here. With an initial estimated allocation of $250 million in a separately managed account to be held in bank at the Bank of New York Mellon. Throughout the discussion today, I'll provide an overview of the investment strategy, discuss the structured credit market in general, introduce Golden Tree, as well as review our investment rationale and potential risks that we established throughout the due diligence process. So at a high level, this strategy will target investment-grade securitized credit assets across asset-backed securities, residential mortgage-backed securities, commercial mortgage-backed securities, as well as collateralized loan obligations. This will have the opportunity to invest in European assets when it is attractive, and will maintain a low interest rate duration. The target return on this strategy is approximately LIBOR plus 400 to 600 basis points in the current environment. And the objective is to outperform our mixed credit benchmark over the 3 and 5 year periods.
Steve, did you say your objective is 300 to 400 basis points over LIBOR?
So the return target is LIBOR plus 400 to 600 basis points. Broadly, these are floating rate assets,
So in this environment, we're talking about
like a 5 to 7%
5 to
return
7%?
is their target, you know, if you add in some of their alpha that they can generate. So this should look familiar, but just to touch on where we are in the asset class plan for the year, we've allocated to Guggenheim earlier on, and that's fully invested in multi-sector manager across bonds, loans, and structured credit. Are in the process of funding PineBridge, which is a dedicated bank loan manager, and then today making a recommendation for the structured credit mandate to target security selection or returns through security selection, as well as intra-sector sector rotation within structured credit assets. Thought it would be helpful before we jumped into this to kind of walk through a hypothetical CLO structure as a way to kind of illustrate where we will be investing in the capital structure. And so broadly, structured credit is a special purpose entity where the assets of the business would be credit assets, and then they will issue public debt through securities to the market, which will be the liabilities of the structure, and then equity is generally private investment. We will be targeting the BBB to AA piece of the capital structure. The way that the mechanics of it work are that assets will generate your interest payments, and those will be used to pay down the liability streams from the top of the structure down to the equity. Once all the liabilities are satisfied, all the remaining capital will fall down to the equity investor. The reverse is true if the underlying assets experience any stress, where the first losses will be experienced from the equity investor first, and then the BBs, BBBs, and upward, providing protection to the senior investors in the tranche. A unique feature of this structured credit, in addition, is that if any covenants are violated, the cash flows will be redirected from the equity investor back up to the top of the capital structure. So it effectively de-levers the structure and provides an additional layer of protection to the senior investments or investors where we will be investing. So I covered a lot of ground there and just wanted to pause and see if anyone had any questions. Okay. So we think adding structured credit investments to the mixed credit portfolio is beneficial in a few ways. The first is that it provides additional credit exposures beyond single name corporate credit risk, primarily through accessing consumer credit. So that would be through mortgages, student loans, credit cards, as well as auto loans. In addition, structured credit is generally floating rate in nature, and so it'll reduce the overall interest rate sensitivity to the portfolio through reduced duration. A unique feature of structured credit is that these do not carry LIBOR floors, and so they will participate in the early stages of a rate rise. And lastly, the current opportunity set is attractive by accessing the illiquidity and structural complexity premium. We can demonstrate in the next 2 slides. So what we're looking at is in regards to the return side of this, what you'll notice is the red triangles are structured credit sectors, and that's their average spread, versus the black circles, which are single name corporate credit spreads. And so what we're highlighting in the BBB space, which is investment grade, is approximately 200 basis points of excess compensation you can earn in this space. I think it's also important to illustrate, though, the dispersion that exists between the subsectors of structured credit, which helps to highlight the need for a manager who's making the relative value as well as asset allocation decisions intra-sector. You know, we do recognize that this isn't not a risk-free asset class, but there are mechanisms, as discussed with the cash flow, the subordination as well as how cash flows are redirected. But I thought an example would be beneficial to help explain how this has worked historically. And so we're using a historical CLO default experience that has been produced by Wells Fargo. Or I'm sorry, yeah, it was Wells Fargo. If we look at the BBB piece of this, Historically, over the past 15 years, triple B tranches of CLOs have experienced 0.5% defaults cumulatively versus 7.6% over the prior 15 years for single-name corporate credits. I think that, coupled with the prior slide, helped to illustrate a higher compensation per unit of risk or a greater risk-adjusted return. Part of the mechanics of structured credit help to support this through diversification of the pool of assets. In the case of a CLO, you have 200-plus bank loans that are supporting a security versus one independent corporate issuer. In addition, there's the equity subordination as well as the mechanism that redirect cash flows from the equity to the senior tranches. In addition, post-financial crisis, there's been greater regulation in this space that have helped to support both the diversification as well as the equity subordination and cash flows. So pause there before we hop into GoldenTree if there's any questions. Great. So GoldenTree is a fundamental credit manager. They manage approximately $22 billion across corporate credit as well as structured credit assets, established in 2000. $3 billion of that capital is dedicated to structured credit, which is run primarily by Joseph Nagar, the CIO of the strategy. He's a part of a 5-member team. GoldenTree is 100% employee-owned, 26 partners, and 19 of those are investment professionals. I think it's important to highlight that of this 197 employees, 90 of them are back office and operational professionals, and it was through our internal as well as Aon Hewitt's operational due diligence provided a pass rating. Whether it's a corporate bond or structured credit, they provide the same or go through the same rigorous investment process that starts with fundamental credit analysis. In the case of structured credit, it's the analysis of the underlying collateral. Then they analyze the structural features of the overall securitization, reviewing the covenants, the waterfall mechanics, as well as call features. But what differentiated them the most from other managers that we identified was that they look for the margin of safety, as well as an identifiable catalyst in the market to drive total return. They define a margin of safety as the amount of stress that the collateral can endure to identify the first dollar of principal loss. They can also use this as a margin of safety calculation as a relative value metric to go across securities and on a risk-adjusted return basis. We chose GoldenTree. What was important to us was to identify a manager who had capabilities across the various structured credit sectors. They've proven this through their expertise both up and down in credit quality as well as across sectors through their experience running a opportunistic structured credit fund that was incepted in year 2007 and since then has returned 22% annualized returns. They have an active trading mentality, which I'll illustrate on the next slide, and also a dynamic risk management function that focuses on liquidity management to weather market stress as well as invest opportunistically following periods of market stress. And lastly, wanted to invest with an investor who interests are aligned with their clients, and their 100% employee-owned structure as well as their 3% of overall firm assets that is employee contributions, we believe align their interests with ours. From an active management perspective, the chart on the top right is illustrating a representative account run next to our mixed credit benchmark. Over the past 2.5 years, net of fees, they've outperformed our benchmark by 100 basis points, but have done so with a higher credit rating, and in addition have done so with a significantly lower interest rate duration, so less sensitivity to rising interest rates. They've done this by adding about 1/3 of their return through price appreciation and about 2/3 from current income. And what's illustrated on the bottom left-hand chart is this price appreciation. With the blue bar is the average buy price, and the green bar is the average sell price throughout a quarter, and on average returned 4.5% during that period from their average buys and sells. The inverse is also true, which is illustrated by the yield compression. Over the same periods, experienced approximately 1% of yield compression. This, in essence, enables them to purchase securities with a higher yield at the time of purchase, but then also realize the benefit of price appreciation over that same time period, and confirms their investment process through their underlying performance. Throughout the process, we identified a few risks on the due diligence process. They're identified and explained in more detail in the DDR, but wanted to highlight a few today. The first is their short track record within the high-grade strategy. We're comfortable with this because it's the same team process as well as systems that are in place since 2007 have supported the opportunistic strategy. In addition, we will be taking tracking error to the South Carolina benchmark, mainly from interest rate as well as credit risk. We think it's prudent in this current environment to be short duration as the Fed's about to embark on a rising rate trajectory, and also their margin of safety investing and focus on the margin of safety gives us comfort in them taking slightly lower credit quality tilt. We identified Joseph Nagar as a key man. If he were to leave the firm or be unable to manage this strategy, we would reconsider this investment. With that said, this is in bank, and so we have the discretion to remove the manager or wind down the account if this were to happen. Recognize this is a less liquid market, but these are CUSIP securities and they do trade daily. If in the event that the market does experience some stress, GoldenTree does have proper risk management systems in place. They assign a daily liquidity score. That score we believe will help them to identify as well as source liquidity in the market. And lastly, employee turnover at the firm has been a little bit higher than we would desire, but we believe that the structured credit team has been stable, and the partnership model creates the right incentives to attract, reward, and retain key employees. So in conclusion, we believe the structured credit asset class to be an attractive sector within the credit markets to enhance risk-adjusted return to South Carolina. The strategy should benefit the mixed credit portfolio by diversifying credit exposures, reducing portfolio duration, as well as benefiting from GoldenTree's total return approach to credit investing. We're recommending a 4% allocation in GoldenTree with initial estimated allocation of $250 million to be held in bank, Bank of New York Mellon, and it's buy rated by Aon Hewitt. We believe we negotiated competitive fees, which are detailed in the term sheet provided to you guys in your packet. Pause at this time to see if you have any questions.
What was the benchmark exactly?
So our benchmark that we'll use will be the mixed credit benchmark, which is a third to high yield, a third to bank loans, and a third to Barclays MBS. They've historically run this as more of a total return approach with a 5 to 7% return target.
What sort of duration did you say?
So they're targeting about 1 year of duration. On
One,
this.
1 year?
Yes. But on the interest rate side, but then the spread duration, which would be more the sensitivity to credit, would be, so probably about 3.5 to 4 years. So if there is 100 basis points below it in spreads, we would see that as about a 4% to price impact.
And again, with that short of duration, what kind of return are you targeting?
LIBOR
LIBOR plus
4 to 600. So if we go back to, I guess, this chart, what you're seeing is in the triple B space, spreads are currently in that 350 to 450 range. And so through their active management, they believe they can add about 100 basis points on top of picking up the beta that's inherent in the market.
Are any of these, well, let's see now, if you're targeting LIBOR plus, but is there any floater involved in these? Is it all floating?
Yeah, predominantly floating rate. And if in the instance that they do invest in a fixed rate bond, we give them the discretion to use, to augment the duration if we would care to have this maintain its lower duration target.
Okay.
But unlike bank loans, which carry a 100 basis point floor, these will participate immediately as rates begin to rise.
Think car loans, franchise loans, credit cards, all that stuff.
Any other questions, Steve? If not, you have the motion to approve GoldenTree in your packet. Is there a motion to approve?
I'd like to amend the motion. I don't know the kind of process for that.
How do we,
He can move to amend it, just
You wanna-
specifies to what he wants to, how he would like to amend.
Yeah,
Go
I
ahead.
think just because it's a new area and it's, more direct, I think 4% on the cap, I mean, the dollar amount is fine, but I think 4%, we might want to bring that number down because 4%, that could be, what, $1.2 billion? Right? I mean, I'd prefer to put a cap on it for right now, 500 or something. I mean, we're not close to that level, but it seemed high.
Yeah, and I should clarify, the 4% links back into the language of the SIOP. And so that's why there's the link back, but yeah, I'm fine if we would want to cap it at a dollar figure on an investment basis.
There's been a motion, there's been a.
Did you want to, excuse me, can I just point one thing out? Since there is a structured component to the underlying benchmark, if we do 2%, that would allow us to be at the target. So just in terms of helping with that, prefer that rather than a dollar amount.
2%, I'm fine with that.
Okay.
So how do we want to?
There's a motion to amend the motion, there's an amendment to the motion to.
Okay, a
amend
motion.
to-
You wanna-
From 40%.
Right, right,
Mr. Chairman, there's in regards to item two, or, part two of the Golden Tree motion, let me read that as authorizing investment up to 4% of total assets into the Golden Tree Structured Credit Strategy through the use of a separately managed account agreement with an anticipated initial investment of $250 million. There's been a motion by Commissioner Gillespie to change that from 4% to 2%, so that you would need to put that to the commission.
All right, you've heard the amendment to the motion. May we have a motion to approve?
Well, it would
The
need-
amendment-
motion to approve
You need a
the
second.
amendment.
You need a second to the motion.
Second to discuss the amendment.
Right.
Second to discuss the amendment.
Right.
All right, any further discussion?
And it's 2%, is that 400 or 600?
About 600.
600.
About 600.
Still a lot of money.
Any further discussion? If not,
All those in favor?
all those in favor? Aye. Opposed? None, motion's carried.
Any discussion, any further discussion on the motion as amended?
Oh, okay, now we need to have any further discussion on the motion to
Yeah, that
amend.
was just on the, yeah,
That
so
was-
now we gotta do it.
Okay,
Motion
that
as
was,
amended.
that was on the the motion
To amend.
to amend.
Right.
Now we have to have a vote on the
Motion as amended.
motion
As amended.
as amended.
Any further
So,
discussion?
second,
Second.
any discussion on that? All right, hearing none. All those in favor? Aye. Opposed? None. So that,
5-0.
that motion is approved. All right.
Chairman, next we have Ashmore.
And that is going to be, all right, next is Ashmore
Mr.
and
Wingo.
Mr. Wingo. Go ahead.
So good afternoon, and thank you for the opportunity to present. I'll be presenting two recommendations today, Ashmore and GMO, specifically within the emerging market debt portfolio. So it's me up here talking. I'd like to give special thanks to Ashley Aslan, who collaborated with me on the due diligence for both of these managers, as well as the public markets team overall. I think this was a joint effort. So to start, I'll give an overview of the market, provide a little bit of color on the space, and then specifically how this recommendation fits into our asset class plan. Then I'll talk about briefly the investment rationale, performance, and then any considerations with respect to both Ashmore and GMO. And then finally, I'll talk a little bit about the portfolio construction aspects of this, and specifically what makes these two managers make particular sense in a portfolio context, as well as on a standalone basis. So what is emerging market debt? So our benchmark is actually a 50-50 blend of a dollar-denominated benchmark and a local currency benchmark. What I'm talking about here today will be the hard currency or dollar-denominated piece of the benchmark. What you can see is, I think, immediately obvious here in the country breakout of the two benchmarks is that we have a vast degree of diversification difference between the two benchmarks. And I think that'll resonate, especially on the next page when we talk about the ability to add alpha in the two spaces. So what we can see here is, in collaboration with our reporting team, what we've done is a study on the historical alpha generation in the two spaces, separating the two asset classes, hard currency and local currency. And so with respect to the active-passive blend of how we position the portfolio, the thing that we're most concerned with is the excess returns. And so what we look at here is both the level and the consistency of those excess returns in hard versus local currency. So in the chart on the top right, what you can see is that the hard currency in the blue bars has, on an annual basis, in every single of the 5 percentiles that I break out here over time, generated significantly more excess returns over time. And then in terms of the consistency of that as well, you can see in the 5 percentiles here that I break out, you can see that the hard currency has also demonstrated significant improvements in terms of excess returns over the space, as one might expect given the different level of differentiation across the two benchmarks. In fact, if you look at the median manager in hard currency versus local currency, they've outperformed 73% of the time versus 43% in the local currency space. So what are the implications of that with respect to how we position the portfolio? So in terms of what I've broken out here is how we're positioned today in the portfolio. We have 80% passive exposure in the hard currency piece of this. And so what the effect of my recommendation today is better aligning us with the higher probability bets in the space in terms of alpha generation. So we'll be moving, the implications here with my recommendation are to move towards roughly 70% active exposure in the hard currency piece of our portfolio. So to summarize, what I'll be recommending today here again is up to 4% of plan allocation in each of two hard currency managers, Ashmore and GMO. The initial contemplated allocation is $300 million each. So Ashmore has a very top-down, research-driven process. And as we'd expect with them, the country allocation decision has driven the excess returns for them. With respect to security selection, they have a focus on liquidity in the space as well. GMO, in contrast, has a focus on rigorous bottom-up underwriting, and as a result, the issue selection decision has tended to drive their returns. With respect to security selection, they have focus on long-term buy-and-hold approach and focus on value. So they have happens to be a very low turnover strategy. These two investment styles are very complementary and will demonstrate later the low correlation of excess returns with the strategy, which makes them very compelling, we think, in a portfolio context as well. Lastly, we've been able to structure, we think, very competitive fees with the two managers. So for Ashmore, the key rationale for why we were recommending an allocation today is they have generated strong absolute and relative performance over their history since inception. They've actually outperformed 99% of the time on 5-year rolling basis. They've generated approximately 800 basis points on average of excess return over their benchmark. They do also add a significant amount of diversification in a portfolio context. Their top-down liquidity-focused approach does tend to mitigate our tracking error actually in a blended portfolio. Also, they've had a consistent team and process since inception. They've been led by Mark Coombs since the strategy's inception in 1992. They also have a strong network of in-country resources, 90 investment professionals spread across actually 9 different offices in EM markets in which they invest. So they do offer a significant amount of research and insight into the regions where they invest. So what I demonstrate here is their performance analytics. What you can see in the chart on the top right is their cumulative since inception performance relative to the benchmark. So in the light blue, we show the benchmark here, and Ashmore's returns on a cumulative basis in the darker blue. Break that down into the decomposition of their returns. What you can see here is the breakout of those returns by country allocation effect and security selection effect here. So on a 2-year rolling basis over the past 7 years, what we can see is that the country allocation effect has constituted a significant portion of their excess returns over time. So considerations that we want to be mindful of with Ashmore and talk about are, one, that the strategy has demonstrated considerable volatility over the time period we've reviewed, and this is something that we've actually gotten comfortable with because it's something that's been characteristic of the top performing managers in the space. What we do see, though, is that volatility has been well rewarded over time, as well as that volatility is actually mitigated in how we intend to implement the portfolio in a blended context. They have underperformed also fairly recently in 2014. They did have some contrarian bets on towards the end of 2014 that actually, if we look at the data more recently, year to date, those bets have played out for them fairly well. So we're comfortable that over the long term they have been able to generate significant excess returns. So I'll pause there for questions on Ashmore before I move on to GMO.
How much leverage is
So the Ashmore has used a small amount of leverage over time historically in their composite. What we're looking at when we look at their performance is a composite of several different accounts, some of which use leverage and some of which have not. They've tended to use leverage primarily for managing liquidity and their exposure. They have used it to take a little bit higher exposure to positions they have conviction in. One of the ways we've gotten comfortable with, we don't contemplate using leverage in our account. I've looked at all of their accounts, and I've looked at the accounts that restricted leverage. The performance has been substantially similar across those accounts. So it's largely, leverage is not integral to their process.
James, I can understand why over the last 5 years, performance has been pretty good because of the differential between developed countries and emerging markets. Now, going forward, obviously, investing in a hard currency gives you the strength of the dollar as opposed to the local currencies. But as interest rates move up here, doesn't that necessarily mean that rates will have to move up in the emerging markets?
Well, I think that overall, U.S. raising rates will be, on balance, strengthening for the dollar. And so,
Right.
On balance, what we're really doing here is sort of, shifting the portfolio to a little bit more active management within the hard currency or the dollar-denominated piece. So, we're staying at weight. I think that they have, they've demonstrated strong results over the past in periods of rising rate environments. EMD, if you look at the past 2 Fed rate hiking cycles, you actually see in the following 12 months following the initial rate hike, the hard currency portion of EMD has performed around 20% on average in those periods. So when you think of hard currency EMD, from a factor perspective and what you have exposure to, you have the U.S. rates piece, but the U.S. rates piece of exposure, but on top of that, you also have the credit spread with respect to each country. That credit spread right now is about 350 basis points on top of U.S. Treasuries. So from a fundamental perspective, you're getting compensated right now at what we think is fair value.
What about default rates?
So default rates in EM within the index, there have been 5 defaults historically. If you look back, the biggest of those was Argentina in 2001. If you want to look at that as a rate over time, you get to an average rate of 66 basis points. Market convention is to use 25 cents recovery. So applying a 75 basis point loss rate on the 66 basis points of historical average losses gets you to a break-even spread compensating you for those defaults of around 50 basis points right now. So we think that the 350 basis points additional excess spread that we have is fair.
And I see the authorization requested is 4% of the total plan assets. That gets us up pretty big number, doesn't it?
Yeah, again, that goes back to the language. I think that, the initial contemplated allocation is $300 million based on how we've constructed this in a blended context. So that's our recommendation initially for both Ashmore and GMO is 300. So I assume you.
Modify that at all?
If that's going to be a consistent modification, we need to actually go back and address that in the SIOP.
I don't know, what do you think?
No, I'm fine with
Are
it's-
you all right?
The main goal is that we're going back to fewer managers, higher conviction, and if we have to make changes and actually do reallocations, you're going to need some of that flexibility to actually allocate to managers. That could be, for some time period, it could be larger allocations than we would normally have for the manager until you get a replacement in.
So 8% of plan assets we're talking about.
In total.
In total,
Possibly.
which then would still have a
But-
cap at the emerging markets level.
Mr. Burke has
So-
I'm sorry.
target exposure for emerging market debt as a whole, 6%. Half of that being hard currency or dollar denominated, the other half being local. So to have, just to be able to satisfy that, right, without having the flexibility to be overweight, it would imply 3% between the two of them. If one of them were to lose a key person, we would obviously want the ability to have the exposure taken over by the other one. So I would encourage nothing less than 3. So I don't know if that's enough of a change to move off of the 4%.
So Herschel, is it fair to say that it's not your intent necessarily to go up to 4% with each of these managers, but rather that you'd like that latitude should you need to move assets around because of a manager departure or something else that occurs in the portfolio?
Right, exactly right. And I guess this is the first meeting that we're kind of picking up on the 4% being a little bit more of a concern. And so I would say that because this is in the SIOP, that may be a point we do wish to revisit as well. But the idea is there's not an intention to go to 4% for these managers. It's a flexibility guideline if you had to for some reason, because you have few managers in these spaces. And so you have the ability to actually allocate to the assets, because your only other option then is to try to find a passive form of emerging markets debt. Or go to cash.
Any other questions, discussion?
I had a question on the fees. While your slide says that the fees are competitive, HEK noted that their fees are higher, both in absolute terms and compared to peers. So could you give me some absolute information to help me understand the difference and how that ranks with the
Yeah,
peers?
let me go back and grab the data. So that was something that we had a little bit of concern on, but please comment on it if
Yeah.
you had that discussion already.
Yeah, no, I can comment on it. Their rack rate fees are expensive relative to peers. The fees we've negotiated are very competitive
Very good.
relative to peers. So you'll see a different fee structure here than what is in their memo.
Yeah, he hasn't talked about it.
No, we haven't talked about GM, but that's it.
Yeah, so Ashmore will be structured as a separate account. GMO has a commingled fund. Their fees are competitive. It is a commingled fund, though. Okay. So with that, let me move on to GMO.
Any other questions on Ashmore? No, James, I guess we can go on to GMO.
Okay, so GMO, the rationale for us here is they do have a unique investment approach. They have, given that transaction costs tend to be very high with NEMD, it's a key advantage to have a manager with a buy and hold approach with very low turnover, so they mitigate the transaction cost aspect of that. And also their approach with a rigorous focus on issue selection provides a significant diversification benefit in a portfolio context with Ashmore. So they've also generated strong historical performance, approximately 500 basis points, cumulative annualized excess returns since inception, which has been 21 years. So they also have a consistent team and approach. They've been led by Tom Cooper since the strategy's inception in 1994. They do have Tina Vandersteel as well, who joined the team as a co-PM with Tom, and in 2004, she actually joined from JP Morgan, where she actually led the team that constructed the hard currency benchmark in the space. So we see that as a key competitive advantage for us as well with GMO. Their results here are shown again in the similar format to Ashmore's, with the cumulative returns and the benchmark returns shown on the upper right. We can see here is they have generated on an absolute basis a level of excess returns that's even exceeded the benchmark. So decomposing those returns on the chart in the bottom right, we can see the contribution from country allocation and security selection. So what we can see here is that in contrast to Ashmore, the security selection component here in the light blue has constituted for GMO roughly 75% of the value add from excess returns historically, which is what we'd expect given their focus on bottom-up underwriting. So the considerations for GMO are, one, that the strategy has experienced periods of significant drawdown during liquidity crises. This is something that we want to be cognizant of. The strategy has recouped these losses quickly, though, following a crisis, and the drawdowns are actually mitigated as well in portfolio context, given the low correlation of the excess returns with Ashmore. Also, the small team here, they do have a concentrated team. We do think that because of this, a departure of either Tom or Tina, the two PMs for the strategy, would require a full reassessment of the strategy and the allocation for us. So that's just something we want to be cognizant of. That being said, we have daily liquidity in this fund. So before I move on, I'll pause for any questions on GMO before I talk about the specific elements of portfolio construction that provide a basis for us to say these make sense in a blended portfolio context.
So if we had a question about fees for GMO, would now be the time?
I do talk about fees here. We'll get to that in a second, so you feel free to ask.
Go
If you'd
ahead.
like, okay.
We'll get to it.
So on a blended basis, what we show here is the excess returns of each Ashmore GMO overlaid with each other. Historical rolling average correlations on a one-year basis, 0.39. What we get here is something that's pretty unique we found in the EMD space. Not only do these managers demonstrate strong performance on their own, based on their differentiated processes, they're generating those excess returns at slightly different times in the market cycle. So what we can see here is a low correlation of excess returns. Jeff talked about information ratio a little bit earlier today. So if you looked at the historical information ratio for Ashmore and GMO on a standalone basis, they're each around 0.7. In a blended portfolio, that number moves to 1. So they're generating more excess return relative to the volatility of that excess return, which we think is a good thing. So to summarize the recommendation today, again, as we've said, is 4%, but with a $300 million contemplated initial allocation. Ashmore will be structured as a separate account in bank assets at BNY with 40 basis points management fee, and GMO with a commingled fund at 52 basis points. So Aon Hewitt, of course, rates both these funds as a buy. We've had due diligence performed internally and by Aon, and we certainly feel high level of conviction with these two managers.
Now, the GMO fees, they have a 50 basis points in and 50 basis points out fee, and that's substantial.
They do.
How does that, can you blend that or figure that into the 52%, 50 basis point management fee? Or
Yeah.
Is there a way to look at that, because that's substantial?
Yeah, that's a reflection actually of the liquidity in the space and of the bid-ask spreads. Actually, what they're trying to do is compensate the fund for the level of bid-ask spreads that actually exist in the space. So those are fees that we'll just pay directly in the separate account. It is a space that's not cheap from a transaction cost standpoint, and so that's something that they do to compensate. That's actually not too far apart from where bid-ask spreads are right now, and it's something that we understand it's a fee there, but we think it's fair.
Yeah, I would add that it's a 40 Act fund, a mutual fund as well. So as far as negotiating the fees, all investors have to be treated exactly the same. And so one of the things that they've done, and what you do see with some commingled funds, is that the cost to get in, so the transactions cost to purchase the securities, instead of having all investors bear that cost, they're charging it to the investor creating it. And that's on the basis if you're coming in or going out. And so if you're in a separate account, to James's point, you have the same cost. And so what they're doing here is, instead of allowing it to be spread out and shared throughout the entire fund, they're charging that to the investor. Over time, and this is a long-term investment, that cost to you is really mitigated and blended out. And so one of the things that you have to think about is, if someone wants to trade in and out of this fund, it's not going to be punitive to the investors who stay in the fund, but it's going to cost the person who wants to come in and out on a frequent basis.
Any other questions? No? Hearing none, then I guess we do have the motion in the packet on both Ashmore and GMO. So we need a motion to approve those two.
I move.
Second? Discussion.
This is just kind of more for down the road, but part of the asset allocation discussion. But I think in EMD and anytime you start talking about kind of sovereign credit risk, right? I mean, it's not as frequent as corporate credit risk. And so I'm not sure if recent historical experience fully explains the full data set out there. So whether that's a Bridgewater or somebody else, or, you know, Kyle Bass has written a lot of this. I mean, I think understanding how sovereign default cycles play out, because they are distinctly different than corporate, you know, generational in nature, is, you know, if we're starting to push 8, 9, 10% of plan assets, I mean, be worth taking a look at.
Allocation to, within the equity side is roughly 4%.
Mm.
And then on the debt side is 6, so that's a total of 10 for plan assets with respect to EMD, or emerging markets, I should say. So,
And Alan, you're suggesting we ought to revisit this?
Well, yeah, well, not revisit, be educated more on it, because like, for example, if you just, let's take U.S. municipals, right? You'd say, okay, there's been 54 rated defaults since 1954, right? Well, that's kicking out the thousands that occurred during the 30s, right?
He only had one state default during the 30s.
But you had a
Arkansas.
lot of municipalities, not
municipalities.
state level, but, you know, local level, right? And how's that work out on severities and recoveries and, you know, the other things that drive your returns? And sovereign defaults, it's like we've only had a few, but historically when they cycle up, I mean, it's like once one goes, a lot of people go, because it becomes easier to repudiate debt and more acceptable. And I mean, there's a social element to default cycles. And let's face it, we might be, you know, first major country to what, you know, coming up, you might just see different attitudes about it, right?
and I think that's one of the things that the underlying managers on an active basis that they're going to consider would be, you know, that default history, and then also what has been that country's willingness to actually be able to or willingness to pay, and then also the other part of that would be their actual ability to pay. And so I think having the combination of those things considered by the active managers to understand from not only a country allocation perspective, but then also the bottom up of the security piece itself is very helpful. And so that's one of the things I do like about the active management component. Doesn't mean they don't make mistakes or that, you know, governments don't change and that willingness could shift, and culturally it shifts. And I think that's kind of what you're getting at too. And you know, so I think the advantage is these are active managers, and so that can help kind of maneuver through that. But I do think it's an interesting point of thinking about it from a much longer term perspective as the world's evolving. Of are we seeing, you know, behaviors across all sovereigns, not just EM, change as well.
Any other comments, discussion?
Motion in a second, Mr. Chairman, just need to call for the vote.
We've had a motion and a second. So, all those in favor, signify by saying aye. Aye. Opposed? One opposed. The motion is carried. Any further business?
I think we're pretty good for the day.
We're right on.
We're right on
Right to
schedule.
the minute. If there is no further business to come before the commission, I think we will stand adjourned.
Stand in recess.
Recess until tomorrow.
Recess until tomorrow at 9 o'clock.
Thank you.